it is a product that is targeting, that is aiming at protecting people from any risks that happen in the world, right? So why should it be separate? Before I continue, I just want to make a small disclaimer, and it's, I work at the Microinsurance Network, and we're going to talk about inclusive insurance. There is this divide, should we call it microinsurance, should we call it inclusive insurance? I would, that's here, it might be a bit controversial sometimes, but it is the same thing, basically. It's just a fashion statement. Microinsurance, people used to call it microinsurance 20 years ago. Now inclusive insurance is much nicer, so that's why we call it like that. I will talk about both as synonyms. So it's, if I say micro, it could be, or inclusive, I'm referring to the same thing. I hope nobody's going to attack me and say, no, inclusive is broader, so you need, there is a small technical difference. To give you a quick overview of inclusive insurance or micro insurance, basically the basic definition is it is insurance that was designed with low-income people in mind. So it's products that were designed for low-income people. So the big question comes now, it's what does it mean, being a low-income person? Where is the limit? Is this person a low-income person or not? Well, when there is regulation, that's easy to solve. Regulators usually define that. At the Microinsurance Network, we define it as someone earning between 2 and 20 international dollars in purchasing power parity. That's a complicated word. So as you can see, $2 to $20 a day is a huge difference. And it brings a lot of people in, and a lot of very diverse people. You cannot really compare someone that earns $2 in one country to someone else that earns $19 somewhere else. So it is a huge, huge bunch of people, and they are all very different. But they all have one thing in common. And the thing that they have in common is that insurers usually don't like them. I'm saying usually because there are some exceptions, but traditional insurers do not like this segment because it is a very difficult segment. It is a tough market, and so they are usually not cared for and they're not protected. Unfortunately, these people are approximately, according to our estimates, it's around 5 billion people are not protected right now. So it's 5 billion people that are either not protected or underprotected. That means they don't have access to any type of insurance or equivalent. But at the same time, they do face the same risks that we all face. They also have health issues. They go to work and might lose everything because of a hurricane. They might have a harvest that doesn't work because of some climatic change, anything that with climatic change. And this is especially true in developing countries where they don't have a social welfare state that protects them. So we have here a contradiction, and it's that usually people that have the means of protecting themselves have more access to insurance than those that don't. Right? So you have, as I said, this big chunk of the global population that has no way of protecting themselves, but at the same time they don't have any income or savings or any way to get back on their feet when something happens. So as I said before, at the Microinsurance Network, we have our estimates, it's 5 billion people, approximately 5 billion people are on or underprotected, which is a very grim outlook, of course, I confess. But at the same time, if you choose to look at the glass half full, it is 5 billion potential new clients. It's 5 billion people that need to be protected, and so it's 5 billion people that potentially could come into the could become clients of anyone that comes up with something interesting. So for us we are a multi-stakeholder organization, so we do not push for any type of product. We're not advocating for this or that type of product, for this or that industry. The only thing that we need to make sure is that we support any initiative that is there to build resilience for low-income communities. And the only thing we ask when anyone develops a product for this community, for any of these people, is they have to be suave. Suave sounds like I like that word. It sounds very smooth. In Spanish, means soft. But it is actually an acronym that was made from the English, and it stands for simple. So any product needs to be simple. You cannot have 1,000 exclusions that are going to make complicated or difficult to understand. It needs to be understood. So whoever is distributing it must make sure that the client, that whoever is taking it up, understands what they're purchasing or what they're getting. It needs to be accessible. So the people that are getting the products need to be able to get it easily. It needs to be valuable, of course. I mean, we're talking about low-income families, so the price needs to be, acceptable, and it needs to be efficient. And efficient means that at the moment of the claim, it needs to be quick and easy for everyone. So that sounds pretty straightforward. If you have that, that's it, right? You have an inclusive insurance product, and then you can protect a lot of people. But unfortunately, it's not that easy, because as a first step, you need to understand who your client segment is. As I said, there is a very, very diverse group of people, and you need to concentrate on one of them. You need to identify who you're gonna target, what they need, and you need to develop your products around that. In the product development world, there is this mantra that you need to be client-centric, and you need to develop products depending on your clients and all of that. Unfortunately, people don't usually do that, especially in the insurance industry. What usually happens is that insurers simply take products they have and try to adapt them how they can and push them on low-income communities just by putting the price down, for example. And that doesn't work. You need to understand who your clients are. And after you did that, and which is, I understand it's a very complicated and difficult process, you go to the next step, which is making sure that they understand you. And that's very tough as well. I think that I would even argue that that's even more difficult. Insurance is a very complicated concept to understand for anyone. I mean, why would you pay for something you actually don't want to use? Nobody wants to use the insurance, but so why pay for it? And this becomes even more challenging when you have bad experiences in the community or something like that. So there is an automatic rejection. So even if you have a product that you are convinced that is going to help these people, it will help them, they will not take it on. They will not take it on because they know someone that had a bad experience, and that's it. So you need to make sure that they understand why it's important for them, how it will protect them if something happens, and that something might happen, and this will make the big difference in their lives. So that's the second point. And then you need to reach them as well, right? After you have successfully survived, let's say, these 2 steps, you need to go to the next one. Okay, you need to reach these people. And here, especially in the micro space, we've seen you need to be very creative and innovative. I think we will hear later of one of the examples of how reaching clients, how thinking outside the box is what is going to make a big difference in how you're going to reach the clients. So that's the next difficult challenge we need to go through. I don't know if anyone has watched the Squid Game. So it's this series where you finish a game, and then if you survive the game, because if you lose then you die or whatever, and then you go in. So this feels a bit like this, because like every step, if you survive the first step, then you go to the next step, and then you have to survive the next step, and then each time you survive one of the steps, you get into a new dreadful challenge, right? It feels a bit like that, because every step in the value chain of this industry is basically a challenge. After you successfully completed these steps, you need to look at each part of the value chain. You need to manage registrations efficiently. You need to be sure that the policy renewals work. You need to make sure that premium collection works, and then you need to be sure that the claims management is efficient. And each of these steps need to be monitored very closely, and it needs to be efficient, because premiums need to be very low, so you don't have a lot of margin here to move, so everything has to be perfectly efficient, and then you have regulation on top of it that is looking at you and every step you're taking. So they're very careful with that, and so everything needs to be, you cannot make mistakes, right? Any mistake can be very, very costly, and especially in this low margin industry, it is a bit tough. So the only way to survive is you need to have scale. And how do you bring scale? Usually is with technology. You need to bring in the technology to somehow to help you with that. I'd like here to make a little emphasis on the importance of claims. Claims is probably the most important part of the puzzle. Claims are basically what insurers sell. The product of, if you have to point out of what an insurance product is, it's a claim. That's the only thing that's important here, it's claim. And especially with low-income communities where there is no, usually they don't have savings or any disposable income or access to credit lines. If something happens, they need to act immediately on it. Any coping mechanism has to be immediate. You need to pay funeral expenses, you need to pay medical bills, you need to repurchase products that you were selling or that were actually helping you in your productive cycle or in your business. And the speed in which this payment is made will make the entire difference. If you have to wait for 6 months for the insurance to pay you, you're back into the circle of poverty, which is actually what we're trying to break, or what we should all be working on to break. So basically, if you look at it, that this is kind of a overall perspective of what this industry is, and then that's why when you understand why traditional insurers usually don't like these clients. It is, as I said, very tough. It is a hard market, and you need to dedicate resources, or at least, you need to dedicate resources, but the most important resource is actually minds and creativity. You need to find a way to make it work that goes out of the traditional, from the traditional circle of what insurance is. And that's when we go back to the beginning, when I said that it should be treated separately. That's one of the main reasons why it should be treated separately. You cannot apply common insurance knowledge into this segment. But someone in the end needs to help this, promote this type of products, right? If the traditional business world or I don't know, how things happen normally, if nobody is there to push for that, it will not happen. And these people will continue to be unprotected. They will continue to have the same problems as they're having. And this is especially true in developing countries. Not everyone, well, most countries in the world don't have the privilege that we all here have to have a state that protects us. When we get sick, we usually can rely on the state to help us. When a hurricane, an earthquake, or something happens, normally we know that the state is gonna provide. This doesn't happen in developing countries, and this is even more true with the effects of climate change. And here I might say something a bit controversial, but if you see who is responsible for climate change, it's mostly industrialized countries, but the effects are mostly felt in developing countries, and most of all felt by, in the productive, let's say, space, by smallholder farmers. Smallholder farmers have been struggling with the effects of climate patterns for several years. They are not protected at all. So, I mean, we can continue a discussion later of who should pay for those premiums, who should be responsible for that. Is it the rich countries? Is it international organizations that should pay for it? Is it the private sector? Is it the beneficiaries themselves, local government? It doesn't really matter. The thing is, we need to find solutions that do protect them. And we need to find them now. So what we do need is to have pioneers that are innovative and are willing to take the new risks of getting into these markets, that people that do not shy away from this type of challenges. And although, as I said before, I don't know much about this industry, about the blockchain industry, I have the feeling that, that there is natural thing that goes together, because this industry is full of pioneers that do not shy away from challenges. I know that there have been a lot of, the entire industry has been struggling to get by and continue to move forward. So, I'd like just to quote a good friend of mine who is actually an expert on, he has a PhD on cryptocurrency and all that. And when he describes all of this as that the blockchain has the capacity of centralizing the marginal. So meaning that everyone who has been marginalized by the financial system could be brought in or incorporated into the system thanks to this technology. It just needs people to want to do it. It just needs all of us to work towards there and to try to share these values. But the big problem that I see from this industry is that it is not well understood. As I said, I don't know much about it, and that creates automatic rejection to it. So I'm sure some of you have felt that already. There is an automatic rejection to anything that's blockchain, that's crypto. Immediately people push it away. And they push it away because they don't know about it. And the only way to change that is by incorporating them into the processes. Trying to, make blockchain education. Blockchain education is as important as financial education for inclusive insurance. You need to help people understand what blockchain is about, to take out this general idea that it is a black box that is operated by a group of technical people that know about it. Just show that it's not. Show that it can be more open and that everyone should have access as long as you know how to deal with that. And so, yeah, just to end quickly, I would just like to say that that's why this forum is great, because it does bring exactly that. It tries to bring together this, blockchain expert, technical expert with other people that are working in the inclusive, social inclusion part of insurance. To, by bringing us together, we can try to learn from each other and see how to move forward and develop something. So yeah. So basically, yeah. As a concluding thing, it's just that it's like by working together, the only way to make this work is by working together, basically. So yeah. So basically, that's all I have to say. So if you have any questions, I'm happy to respond to anything.
Any questions?
Yeah, actually, I spent 6 years trying to resolve that puzzle. I think there are also quite a number of players in the market who are actually doing that. When you're looking at decentralization, I think where that actually really comes in, because there's still also quite a few hurdles to decentralization. It's of course for parametric kind of insurance where it can help, but you could still do that centralized, where the real advantage would come in, and where you can also kind of dodge double regulation issue is when you create like community-based scheme with claims management being done through voting in the community, so that it's not insurance at all. And so some Kenyans here, you have like Harambes and Chamas, try to create a structure like that, decentralize that. Then you stay away from the regulation. That's kind of where decentralization makes sense.
Yeah, I see.
But,
Yeah.
but if for normal claims management, I mean, you still need to convert from crypto into normal, and when you get into normal business, you always get into regulation. When you get into regulation, things get tough.
Yeah, I think one of the key aspects of all of that is that the only way to make it work is if you have a lot of players working together to push together towards, that have common interests. Nobody can do it alone. So if you do this, like you have a great idea, if you don't have someone that is going to help you with the claims process, the claims part, or if you have someone with the distribution that takes care of that, it doesn't work. You cannot do it alone. And that's, I think, from all the successful schemes, that's what you can learn from them, that everyone has been working together, and including states and governments and regulators. In all the spaces where the regulator has been convinced that it works much better. Because you don't create an unnecessary enemy, basically. Because it is not necessary. Like, you're working for the same thing. It's to protect the people in the end. So by being open and transparent, and there is a potential of being completely open. That's when people trust each other more, especially all the partners that are working together in this type of schemes. Yeah, I would say. Yes.
You mentioned issues with like exclusions and that kind of thing, and lots of on like developing markets and that. But for example, in the US, if there's a hurricane or a flood, we often say, well, it's an act of God, we're not going to pay you. Or there's all sorts of exclusions, which is what you were mentioning. To what extent do you think like a decentralized system or like decentralized data oracles could help with making things more transparent?
Well, normally with inclusive insurance contracts or agreements or whatever you want to call them, they should be very specific. So usually they are either for hurricanes or they are for drought. So in the decentralized scheme, when you have, it is easy to monitor if there is going to be a hurricane. There are ways to do it in a very objective way. You just use different tools that you have, and it's the same for droughts or if there are floods and this type of things. And this can all be linked, right? But for the product, it needs to be very clear. It needs to be clear for the smart contract or the way you do it, but it also has to be clear for the beneficiary. The beneficiary needs to understand that what he's protected from is from flood. He's not protected from fire, for example. Or maybe he's protected from fire, but it needs to be clear. What is not good, what cannot happen is to have, okay, you have home insurance, that's it. Okay, what does it mean to have home insurance? If there's a hurricane, does it protect? Oh no, if there's a hurricane, then maybe not. And if there's fire, oh, maybe fire not. So that's what you have to avoid in this type of contracts. And we know that, we all have contracts like this where we have like 3 pages of really small print that nobody reads. It's like you're trying to figure out how it works. You only read it when you have to make a claim, actually. You have to make a claim, it's like, okay, does it go in here? So that's when we talk about inclusive insurance, that's what cannot happen. You cannot have that section.
Okay, I think we need to end the session. Thank you very much again, Asier.
Okay. Okay, I think I need to wait there to take this off.
Hi, good morning, everybody. My name is Michiel Bärnreuther. I'm with Etherisc. And it's my honor to announce our partner, Benson from Acre Africa. All right. And he needs to get a microphone. Is everybody able to hear properly in the back in the room as well? Okay. Yeah? Very good. All right, attention please, we're ready for the next one. Benson, the floor is yours.
Hello everyone. Good morning. I'm glad to be here. My name is Benson Njuguna. I'm from a country in Kenya, a country in Africa, in the east of Africa called Kenya. And yeah, that's where we've been doing. It's considered a developing nation. and we've been doing some work with the smallholder farmers. Yeah, and I'm here to talk about that. So my background is in computer science. So I have done a bit of computer science in school. I've done some consulting work in technology, and that has transitioned me to blockchain technology. That's where I started working with Acre Africa. Acre Africa is an acronym representing agriculture and climate risk enterprise. So that's the full name of the organization. So that's where I've been working. I'm very excited to be here today, to be in Europe. This is my first time, actually. So I'm really looking forward to see the slopes, the snowy slopes, and enjoy the sight and see how people actually ski. You know, actually in Kenya, in my village as small boys, we actually do ski. Yes, 0 snow, nothing, just mud, and we have our own skiing gear, we have our own company, and actually, you may not call it skiing, you may call it sliding, but yeah, this is how we roll. Yeah, so it's a common game in most of the villages where we just pour water and yeah, enjoy the ride. So I'm really honored and glad to be here. And with this, I want to bring about the difference in life. Life is truly different depending on where you come from. So we realize one region might experience more opportunities, might experience faster growth, might experience different privileges than other regions in the world. But yet, today, we're here because of people who had the courage to take a step and come into a country where the opportunities are a bit different and try to make a difference. So I'd give it up for Etherisc. I'd give it up for the Ethereum Foundation, for really bringing about a lot of impact in Africa, and the work is going on as well. Yeah, I didn't mention I'm also an Ethereum Foundation fellow. So with a team of people passionate in blockchain in Africa, we come together and organize different training events, different meetups, training each other, looking for ways that we can increase the adoption, because we actually feel that the blockchain is an infinite garden. As Aya puts it, it's actually an infinite garden, and everybody just needs to play their part so that at every given point in this garden, everyone gets equal opportunity, everyone gets to eat. The fruit from the north is equal to the fruit from the south. So, yeah, so this is a famous quote from one of our teachers that says, "No two individuals are ever the same. You cannot equate people, you can only create equal opportunity." So, I'll jump now into insurance. So, as Asier has mentioned, in developing nations like in Kenya, we have seen a lot of problems, especially because of climate change. Now, climate change has led to some really adverse weather conditions. These are mostly things like floods and also things like drought, like a famine. So you receive no rain. So before climate events took place, the weather was quite consistent. You would know between this month and this month, the rain would start. Between this month and this month, the rain stops, and farmers were able to plan very well their planting times, because most of the agriculture is dependent on rain. But we've seen that patterns have changed quite a while, from quite some time now. And yeah, we've seen this is attributed to the weather events. Now, what has that led to? If a farmer experiences drought, definitely the crops and the produce that they have will reduce. Now, if they used to get in an acre an average of 10 bags, they can get as little as one debe. One debe is around 15 kgs, and the bag is around usually, depending, big 50 kgs. So you will see a huge difference. Now, this leads to two things. So the first thing is the food for themselves, because most of the smallholder farmers, they plant for subsistence as well as for selling. So if there is no produce, it means they don't get food. That's number one. And then number two, this food that they would have sold to get some money, it means less income. Another problem, which is additional pain into their lives, is some of these farmers will have usually gone and borrowed to plant. Assuming a farmer borrowed and planted, and then there was this effect, and now they not only don't have food, they now don't have income, they are now in debt. So it's a huge problem that we are calling the poverty trap, because now it becomes a race to pay debt, a race to look for money to plant in the next season, and the next season might be 3 months away minimum. So between these 3 months, this is where you realize we have troubles you hear kids are not able to go to school. Why? Something happened at home, the parent is not able to afford additional things. So then now it leads to other problems. Like now this is where you see in that area, if there was no food, the country, the region experiences food insecurity. Because if famine takes place or drought happens, it happens in the entire area. Unless somebody who is a bit well off was doing irrigation, or somebody who was living in the river that is rarely dries, those ones might a bit survive. But you realize the entire region lacks food and becomes a problem, not only for the country, but also a global problem in terms of food security. And then in reduced investment opportunities. Now, the more you hold income, I know most of you guys know, the more you're able to diversify your savings. If you have savings, then you'll be able to put it in a vehicle, an investment vehicle. You're able to do more things in future. But now having no income, then you lose the opportunity of making any sort of investment. And now, yes, as I said, it becomes a trap, poverty trap. The trap that trapped your father, if you didn't leave the village, is a trap that traps the kid who takes up the farm. And usually, for example, in Kenya, once the inheritance, what happens is you pick, as a father, if this is a whole piece of land, this side, you pick one of your child, give them that portion, you pick the other one, give them their portion. If they don't get the opportunity to go to school and further opportunities in the urban setting, then they remain there. They build their house at the corner, and they will continue tilling the small piece, and their brothers, siblings, the other side. So it becomes a real trap. And now, due to this, companies like microinsurance organizations, insurance companies, because of pressure, introduce insurance. This is what we referred to initially as traditional insurance. Now, huge lands where we have the large-scale farmers had insurance. So these insurance companies felt these farmers, the large-scale ones, are good customers. Yeah, they're able to pay a good premium. They're able to conduct different exercises on such pieces of land, like field assessment. But now, when they got pressure to try and support the smallholder farmers, most of them did, as Asier said, that you take up the same product and try to make it cheaper and try to make it apply to smallholder farmers. It does not work like that. It's not easy. And also the same models. For example, it involves somebody going to the field, checking, did this farmer experience loss? Yes, they tick a piece of paper. Did this one? No. So it's high administrative cost. Not only going to the field, we also have the costs of how it ran. It's setting up satellite stations near the rural areas where farmers would walk in, sign papers, or get agents from those rural satellite stations, move into the different farms and sign up using papers. So it's really, we've seen the traditional model does not really work, as you alluded to. We need to put our brains together and come up with solutions. And that is what we have seen with companies like Acre Africa. I mean, the next speaker from Pula, so they're doing also awesome things there. So, where I'm working with Acre Africa, they came in to solve the traditional insurance problems. Now, what is innovation? I now have a new word that I'll be using, suave. So you have to look at the different ways that you're going to solve this problem. So the first thing that Acre Africa did was to look at the farmer, the smallholder farmer, in a unique way, not comparing them to the large-scale farmers, but looking how can we solve this particular problem. So then that's where the remote sensing type of insurance came from. So instead of somebody going to the field, now we use satellite to monitor the fields. So I'll be talking about that in a bit. So let me just give you a brief introduction of Acre Africa and what they do. So Acre Africa acts as an intermediary between the farmer and the insurance company. It's not an insurance company. It's more like a calculating agent. They design insurance products. So a team of actuarial scientists and agronomists will sit down, look at a crop, look at the regions this crop could do well, look at how much rainfall this crop would need or temperature, and from there, design a product. So the designing of a product means coming up with a trigger saying, okay, if rainfall is between 2 millimeters and 3, this crop can do very well in this specific area. So they come up with all sorts of triggers. Could be rainfall, it could be vegetative index, it could be the level of moisture in the soil, and all that. So that's what Acre does. So it's more a parametric insurance, so driven by these triggers as the parameters. Now, Acre Africa also has targeted the smallholder farmers because as I mentioned, there was a gap. And yeah, over the years, it has done quite a lot in terms of the parametric, but it's like he said, a squid game. You need to solve everything. Yeah, you've solved the product. You've solved, then how do you distribute? How will they get this product? And now using technology and other models, this is how Acre has dealt with the different problems. So the first problem of data, so pooling satellite data and using this data to determine a payout or not. The second thing has been distribution using the mobile phones. So the uptake of mobile phones in, for example, the developing world has been really good. If there's something that has really increased in terms of the speed of adoption, has been the adoption of mobile phones. Could be not a smartphone, but a normal button phone. We call them the feature phones, or we call them in Swahili, mulika mwizi. So mulika means turning off the light, mwizi means a thief. So people in the village use they come with a torch. So they call it the mulika mwizi phone because you use it as a torch in the village at night. So it has gone up to almost every individual in the rural areas have this mulika mwizi phone, the feature phone. And so we've used that for distribution. So mulika mwizi has the ability you're able to dial star 800 hash, it's called a USSD service. And from there, they're able to access a menu of the different products, looking at their location, looking at what they want to plant, looking at the size of land. They give all these details. Another thing that has high adoption is mobile money. I'm sure most of you might have heard of the M-Pesa It's a mobile transfer system where you can transfer as simple as sending a text, and then money has moved from me to the person I've sent the text to. Obviously, it has a bit of complication in the back end. Yeah, which has very high adoption, especially in Kenya. So combining these two things has enabled a farmer to access a menu of insurance product, has been given the ability to pay for this insurance product using the same device and using technology, triangulation technology of the device, also getting the location of the farm. Now, those are the three key things that you would need to write up a policy. So you know the location, know the phone number is the identity, since the phone numbers have been registered. And yeah, finally, you're able to collect premiums for them if they wish to now be covered. Now, additionally, one revolutionizing thing Acre Africa is doing is we have what we call a picture-based assessment. So a team of village champions, which I'll talk about in the next point. So it's a team of agents on the ground who are trained and given smartphones. So they work with farmers. They are originally farmers themselves, but we call them lead farmers. In this area, we have one who is a bit influential, former civil servant or a former teacher. So we come in, train them, give them smartphones, and then through the smartphones, using a certain application, they take pictures of the farmer fields. So one champion could have 20 to 200 farmers that they support. So a village champion is somebody who acts as their access to market, acts as their access to inputs, acts as their access to information, especially the good farming practices and other agronomic services. So such a village champion gets a phone, takes these pictures, and now, as we continue to innovate, these pictures are compared against the other satellite data. And with time, we are creating an artificial intelligence model that from the pictures themselves, we'll be able to just now determine whether they should be paid or not. Still a parametric way of dealing with insurance. Yeah, and the village champion model, which I've talked about, yeah, it's an individuals who work with the farmers. I'll not repeat. And finally, while we're here, the parametric insurance on blockchain. Now, we've solved the problem of distribution. Now, we needed to solve the problem of claims. Now, Acre is not an insurance company, so it cannot pay claims. It needs to work with an insurance company. The bureaucracy in the traditional insurance companies now is starting to creep in. Now, how do you solve it? We introduce a technology that helps, one, in transparency. You see, I don't say insurance companies can do this or do this. If at times the trigger means will cause the company to pay a lot of claims, somebody who is not good might decide to change the triggers. The triggers used during onboarding are not the same ones used during the payout. How would we know? It's a black box. Nobody knows. In fact, one of the problems was the flow of information down to the farmers. Now, to solve this, blockchain. So we're able to get weather information, we're able to notarize the triggers and automatically generate payout schedules, because there's this engine. Let me show you how it works. So once the farmer is onboarded on one side, the customer data comes in a contract review engine. Contract review engine brings together weather data, farmer data, which is their location, the amount they paid, and also brings in the actuarial formulas. So using the calculation at this point, they're able to produce a list of people who should be paid or not, which is very accurate, which is now a list that can be trusted because it's being done using a smart contract and on the blockchain. So this has led to a lot of benefits, which I'll not mention. I think now you understand. We have more improved products. We have better distribution. We have reduced the cost. Let me talk about cost a bit. So insurance usually works with what we call a premium rate. So if I pay 10 shillings, $10, and the rate is 10%, so it means in case of anything, I might get a maximum of 10 times 10, so $100. Yeah. So reducing cost means you can get an equivalent of $100 in cover, but you've only paid $4. So it means they have more value for less amount of money. So that is what efficiency is enabling us to do, because of reducing the maintenance cost and all the cost involved because of using technology. Now, yeah, and in terms of impact, well, we have major 9 impacts that we deal with based on the UN goals, but yeah, not look at them. I think you can see them clearly. And in terms of impact, so from the time Acre Africa began, in terms of number of farmers has reached is 3 million. Now, this is parametric, but then we've been improving using blockchain, we've been improving using new products. In terms of blockchain, so far, the number of people that we've touched, we've worked with Etherisc for 2 seasons, and we've managed to reach 21,000. That number is going to grow. But generally, the village champions, these people in the village that we've managed to give jobs, because it becomes, they're creating themselves as an enterprise. So it's around 2,000 village champions in different areas. And well, something exciting as well, in terms of the number of women that have been involved and whose lives have changed, because there has been a problem in terms of culture a bit in Africa, where the woman would stay at home, look after the kids, the dad would go outside, fend for the family, come back. So women were not really involved in economic activities. But through our program, we've seen around 60% of the total farmers and the village champions being actually women. So it's a good inclusion. So yeah, and other statistics of the claims paid and total value of insurance. So what lessons have we learned? In terms, blockchain is not an easy concept to explain. So we don't explain the blockchain to the farmer. We explain the value. So you used to receive your claims 3 months after. Now you'll be able to receive immediately at the end of the season, or even during the season, because blockchain brings these aspects of it's near real time, because it's checking. You see, like checking the weather conditions in real time, and it's able to advise on the farmers in real time. So more integrations need to take place. Acre Africa needs to integrate with insurance companies and other people so that we all work from one platform. It does not make sense that one is efficient, but then another one is not. And also synergy. So insurance is not the only solution to poverty. So it's part of the solution, and it has to come and work along with other things like credit providers, input service providers to bring certified seeds, government to bring training, etc., etc. So in future, we want to reach more countries, we want to improve the product, not only to use rainfall indexes, but soil moisture indices that cover less areas, and also to work with key partners. If anyone of you here is interested to work with us, we can chat after this, and we can see possible ways of working together and continuing to scale this solution. Thank you. I'm off. Yeah, I'm off to skiing. Yeah, this is how we do it in Africa, and I'll try your way now. Thank you very much. Any questions?
Thank you so much, Benson. We're running a little bit late, so we have
one question.
One question,
yeah.
Perhaps.
Okay. Yes,
so
one question. Yeah.
Hi, Benson. Thanks for coming and giving this talk. I actually grew up in the south of Germany, close to the Alps, so I can be a good skiing.
Nice.
I think what a great talk, and it really shows the use case of decentralized insurance. I want to ask at sort of a $5 premium to $50, $5 premium to $50 payout. When I ask about distribution channels, because clearly in traditional insurance, the penetration rate in agricultural insurance is less than 3%. I want to understand the economics for the village champions that you've mentioned. You've mentioned a champion can serve between 20 and 200 farmers, so that's something between $100 and $1,000 of revenue generated for this farmer, for this village champion per season. How much of the economics can go back to him, so that village farmer, how much can he earn from that, because effectively he needs to make a living as well? And what are his costs associated, and how do you find and train these people, and how do the economics work from that perspective?
Yeah, thank you very much. Wonderful question. So the village champion, number one, as an insurance agent of sorts, gets from every premium, they get a 10%. It's by law, for example, in Kenya. Then additionally, insurance goes along bundled with, for example, a bag of seed, which is around $500. The bag of seed, actual cost of production could be $400, so there's $100, okay, it's not dollar, okay, shillings. So a bag of seed would be 500 shillings, which is around $5. Now, it gives them a margin of $1 to play around with. For example, it's shared between the logistics and shared between the salesperson. So they get around 30 cents for a bag of seed. And yeah, that's one thing. Then they also get, because of the capacity building programs going on, so if they're well trained, usually they also get some income because of doing trainings, income because of doing sales of credit as well. So all these different programs, when they come together, they're able to raise a considerable amount of money that is a bit sustainable for the champion, but only works in some regions. Other regions, you have to come in and try and assist. But yeah, that's an area we need more bundling, more products. Anybody wants to reach the farmer, because the more we have more things through this champion, the more we can make him earn more. Yeah, and how we get them is through the farmers themselves. We know the farmers, we ask who is more influential, who meets this criteria of able to understand a bit of English, able to has this sort of experience, and then we get the leader from that village. So it's where we use the village model, so per village or per ward, it's an administrative boundary. And yeah, we, as the Acre team, goes to the ground, trains them, at times some online training through Zoom, especially during the COVID. Yeah, that's how we do it. Thank you very much. I appreciate your time. Good day.
Thank you very much, Benson. Right now we're having Elise from Pula Advisors. She's also part of the Lemonade Crypto Climate Coalition. Thank you very much for coming over here.
Thank you.
You have access
yes,
to
I had a quick presentation, so while we're pulling that up, thank you, Benson. I don't know where he's gone. And thank you also to the Etherisc team for inviting me to participate in the D1 conference. Actually, before we start my slides, the briefing that I received for this session was to just give a context about the situation of smallholder farmers. And I think in the last two sessions, we've had sort of two different perspectives on that. So I don't want to really repeat some of the things that were already covered. But just to give a little bit of a personal introduction, my name again is Elise Lee. I'm with a company called Pula Advisors. As was introduced, we are a proud member of the Lemonade Crypto Climate Coalition, which is aiming to use blockchain to help vulnerable communities against climate change. And so as a company, we are working in the agricultural insurance space, largely in a very similar way as Acre Africa. I haven't personally come across Acre Africa because I am part of the Asia-facing team at Pula. And so I joined the Pula team about 15 months ago to do the business development outside of Africa. And to date, we've had some success in a number of countries. And so, yeah, I mean, I can talk to you about that as well. But today, I just wanted to really focus on the smallholder farmer and just really just kind of give a context of what is the problem we are collectively trying to solve. And so I came into this space a little bit differently, and I didn't really know, what the audience is going to look like. And so I was born in South Korea, in Seoul, but at a very young age, my dad's job sent us to the US. That's why I sound like the way that I do. I spent about 14 years in the US in my formative years. And then after graduating from university, I was predominantly in the development sector. So working in the philanthropic sector, working in largely foundations, private foundations, corporate foundations, and the like, to basically do sort of channeling of philanthropic and donor funds into the NGO sector. And after 15 years of doing that, I really thought, okay, it's time to go into the private sector because there's only so much you can do with donor money. To get to scalable, sustainable solutions, I mean, you really can't do that on a purely philanthropic basis. And so, while I was thinking, okay, what can I do? What should I? Then I was contacted on LinkedIn by a headhunter sitting somewhere in the UK, asking me if I wanted to join a company that's based out of Kenya. And so here I am today. And so that's, I think, and now, I mean, I currently am based in Rotterdam. I'm married to a Dutchman, and I dragged him back to his mother country after living 15 years in Asia. And, all day I'm just on Zoom talking to Pakistan, Nepal, Sri Lanka, and then you sprinkle in a couple of calls with my colleagues in the head office or some of the other ones in satellite offices. But the overall problem that we're trying to solve is, one of, this lack of penetration of agricultural insurance into the smallholder segment. And so, how many of you have any, are farmers, let's say? Anybody does farming on the side? Okay, one person. Yeah, I thought maybe you might be. Yes. And so if I ask this question in Nepal, actually even our national operations manager, he recently admitted to me that he himself is also a paddy farmer. And so then the distribution of farmer to non-farmer ratio is different depending on context. But I myself am also not a farmer. And I was looking for a video that might give you a pictorial image of, what it's like to be a farmer, a smallholder farmer today. So the good people at Bayer Science has put together this two-minute introduction to smallholder farming.
Smallholder farming is anything but small. It's the basis of life for millions of farmers around the world. Every single day, smallholders like Ruth put all their dedication, their passion, and loads of work into a small but precious piece of farmland. Thanks to their efforts, a growing world population can be fed each day. Something to be truly proud of. But often, smallholders have to face major challenges that make it difficult to grow the quantity and quality of crops they need to care for their families.
Kama mimi mkulima mdogo, niko na changamoto nyingi. Hata mbegu sipati mbegu ile nzuri natakikana. Nikanunua mbegu kwa majirani wangu.
Challenge na nga hong kahumayan ang madaot sa piste o sa usob-usob nga panahon tungod sa climate change. Mga ahongi sani puling.
वहाँ बहुत बड़ा चीटिंग है, फ्रॉड लोग बैठे हुए हैं, चीटर लोग किसानों से बहुत चीटिंग करते हैं, अपना बेच के माल जो है 20 रुपए में 15 रुपए किसानों को पकड़ा देते हैं। ये समस्या है, ये गंभीर समस्या है हमारे मंडी की।
Papu, Ruth, and Henry imagine a world where they're able to unlock their full farming potential so they can get the most out of their farmland and lead a better life.
good people at Bayer. But 84% of the world's 570 million farmers are smallholder farmers. And the definition of a smallholder farmer is a farmer who is plotting on less than 2 hectares of land. And so for those of you who don't know what a hectare is, like I didn't before I joined Pula, it's a 100 meters by 100 meters box is basically 1 hectare. And so if it's 2 hectares or below, then you're considered a smallholder farmer. And smallholder farmers as a collective entity produce 35% of the world's food source. And so another sort of a fact point I'd like to share is that, as we have heard from some of the other speakers, is that smallholder farmers are some of the poorest people on the planet. And tragically and somewhat ironically, they're also one of the most vulnerable to food security. So you would think that if you're actually involved in food production, then you would have better access to food. But actually, paradoxically, they are more likely to go hungry than other segments of society. And also, as we have heard from the other speakers, the smallholder farmer segment, as a collective, are also more vulnerable to climate change and are the most exposed to disaster risk. And so we see, rises in average temperatures. That has an impact on increased water stress. Many of the most vulnerable farming communities are still rain-fed farming rather than irrigation farming. And so that results in reduced yields and reduced food security as well as reduced incomes for those farming families. And so already poor households are disproportionately affected by extreme weather events such as typhoons or hurricanes, floods, as well as droughts. And this also, we're hearing this a number of times, but the insurance penetration is extremely low outside of Asia and India in terms of the agricultural insurance penetration. And so I shared the QR code for a recent GIZ report, which basically is a very comprehensive report on what is going on in the agricultural insurance space. And so I invite those of you that are interested in this topic to read that. It's an excellent report and where this infographic has been pulled. But some of the benefits or the role of insurance, and they mentioned 5. So the first is basically to be able to, give protection against risks that would otherwise, that farmers would otherwise not be able to cope with. And so this is a risk transfer, a financial tool to do risk transfer. But in the absence of that tool, farmers have many different kinds of coping strategies. However, these coping strategies actually are more expensive if you actually do a dollar-to-dollar comparison. And so using a vehicle like insurance can be a more cost-effective way to manage that risk rather than to do diversification of crops or do pooling, of different resources within the community, so forth, which is done in the absence of insurance. When the insurance is properly designed, it can also act as a vehicle to substitute for collateral to enable the unlocking of credit and unlocking and increasing the access to finance to be able to buy better inputs such as seed or fertilizer or any other inputs to be able to have a more productive situation. And it can also allow not only the farmers, but other stakeholders to take on additional risks, to be able to invest into smallholder farming, to adopt new technologies, to improve farming practices, and then also have more systemic increases in productivity. And then, of course, there's also the advantage of, the timely access to cash compensation as opposed to sort of, more traditional methods. And so, all of these things together, I think, we're in a room, we're preaching to the converted, so to speak. And so we all understand, what is the role that insurance can play. And certainly Pula Advisors, has been a leading company in basically bringing, insurance into the hands of the smallholder market. And now we're looking to see how we can include the element of blockchain into that process. Thank you.
Thank you so much. Thank you.
I'm going to take maybe just a general question. How do you link the blockchain directly to normal payments? Are these private blockchains or public blockchain?
I will dive into that in the next session. Okay. Thank you so much. The next speaker will be a virtual speaker. That's from Lemonade, Confino. So I have to check how we're going to do this over here. If it's going to happen through this machine. So give me a minute, please. Which one is the Zoom laptop?
now I think we have solved the problems, and we now say welcome to Roy Confino from Lemonade, and he will now introduce us in the work done by the Lemonade Crypto Climate Coalition. And yeah, welcome Roy, and the stage is yours.
We're muted. He's muted. We're muted.
I'll text him.
Okay. Just unmute and say you're live.
Roy, you're live.
Stage is yours, Roy.
Okay, great. Thanks so much, everyone. I can't actually see the crowd, but I'm assuming there are people in the room. So let me share my slides. All right, can everyone see that? Okay, great. So thanks so much for your time, everyone. I really appreciate it. I'm Roy from the Lemonade Foundation. The Lemonade Foundation is the nonprofit arm of Lemonade, the insurtech company, and our mission is to use exponential technology like blockchain to solve real-world problems. And we're really excited to tell you about the first project that we're going to be working on to do exactly that. It's called the Lemonade Crypto Climate Coalition. Etherisc is part of it. And it's the first organization built from the ground up, first Web3 organization built from the ground up to protect subsistence farmers from climate risk. But before I go into a bit more detail about that, I'd like to start with an observation and a prediction. My observation is that although blockchain has the potential to bring about dramatic, fundamental, maybe even historic changes to the way we function as a society, those changes have not yet trickled down and affected the people most in need: the unbanked, the uninsured, and the unprotected. And my prediction is that insurance is the bridgehead that will allow us to use blockchain to influence the real world. And that's especially true for climate change. And I hope when I finish this presentation, you'll see why I believe this. Let's go into a bit more detail. So I guess we're all here because we believe in the power of blockchain to create a future that's, collectively owned. But in the 13 years, excuse me, since Bitcoin white paper, I'm not sure how much of that potential has been released and used to change the lives of the people who really need this the most. And this is something that we've been thinking about a lot at the Lemonade Foundation: commit to not investing in fossil fuel. This is a problem that's very, in our minds, very important. Unfortunately, it's also intensifying, right? So climate risk is becoming worse over time, which means more droughts and more floods. And even more unfortunately, those droughts and floods are predominantly affecting the developing world or the emerging economies. And in the developing world, we have 500 million smallholder farms. That's almost 2 billion people, a quarter of the world population, that basically live off what they grow. And for them, too little or too much rain is literally life-threatening. I know some of the people here work in this space, so you're very familiar with it. And Unfortunately, today, these people have no option but to bear the risk of climate change on their own. One of the things that I remember, I grew up in Kenya, and one of the things that I remember is that this is very, very prevalent. So in Kenya, for example, where I grew up, less than 3% of people even have access to insurance, let alone have bought insurance. And we believe that blockchain potentially could be a tool to pool this risk, to flatten the curve. And the tool to do that is insurance. If we're able to use insurance and weather data and blockchain together, we believe we can unlock the main inhibitor of scaling for insurance in the developing world until now, and that's costs. So for a traditional insurer, providing this type of insurance in the developing world is just not feasible. Going through an underwriting process, which is complicated and expensive, is not going to happen when premiums are so low, $2, $3, $4, $5 per farmer per planting season. Even if you did have underwriting, distribution would be impossible because traditional companies work through brokers and agents who take a cut of the premium, and if the premium is so low, that's not going to happen. And even if you did do that, claim processing would be impossible because the actual processing of the claim could potentially cost more than the payout. So this is what the Lemonade Crypto Climate Coalition wants us to do. We brought in companies from different walks of life, from insurance, reinsurance, from Web3, and from data. And the idea is to work together to solve this problem. And the way we want to solve it is using a DAO instead of a traditional insurance company, smart contracts instead of policy documents, oracles instead of claims adjusters. And if we're able to do that, we can potentially turn something that's unsustainable to a product that's infinitely scalable, because the blockchain can reach rural Kenya just as it can reach Peru or Papua New Guinea. Another important factor is that we want to provide this at cost. So the expected loss of the farmer is what we're going to be charging them. There's, at least for the DAO, there's going to be no profit in this. By doing this, we hope, again, to solve the cost problem. And a very good use case to do that is weather data. And the reason this is a great use case is that weather data can be objectively measured, it can be instantly reported, and it can be automatically triggered, which means we can use historical databases to price the insurance, and then we can use real-time weather data to trigger the events, which means that a farmer can have instant payout, which is much, much better than the process that they are conducting today. And something I forgot to mention, who the hell trusts their insurance company, right? So if you think about it, another upside of this, the way that we're structuring it, is that this can help us go from a model that's distrusted to a model that's trustless. Because when the decision about making or not making a payment is taken away from some nameless bureaucracy, and it's right there, it's on chain for everyone to see, for everyone to validate, it means that, it doesn't mean that the stakeholders don't trust each other. It just means that they don't have to trust each other because the code and the data make the decision. This is also something that hopefully and potentially could be a big unlock for blockchain-based insurance. And just because it's on-chain, it doesn't mean that it has to be complicated. And again, many of the speakers here will be very familiar with this. This is, for example, M-Pesa in Kenya. The way that we are envisioning the product is that the farmer will not have to change the way they interact with the world at the moment. So directly from their phone, they'll be able to get a immediate insurance quote. They'll be able to buy it from their phone using a mobile wallet like M-Pesa. And then behind the scenes, under the hood, we'll take that money, we'll park it in a smart contract on the Avalanche blockchain, which is very, very low gas fees. And also, because it's proof of stake, it doesn't have a detrimental environmental effect. And then once a trigger event happens and is reported through the Oracle, through Chainlink to the chain, we can transfer that information, and the money flows back into the same phone, the same mobile wallet that bought the policy. Initially, the Lemonade Crypto Climate Coalition is going to be funding the capital to backstop these insurance policies, these smart contracts. But over time, we want to allow every crypto investor to participate in this. We're also beginning issuing a token that will allow or incentivize the broader community to take part. And just a bit about the timeline. We formed the coalition. We're at the moment in the process of working on the white paper, registering the DAO. We hope to launch a pilot towards Q4 in Africa, which we're already working on, and then use next year to scale and to issue a governance token. As I said in the beginning, I think we all agree on this, that blockchain has the potential to make dramatic, maybe even historic changes in our society. And our job in the coalition is to make sure that those changes happen. We brought together a group of unlikely business partners from different walks of life to work together on one of the most ambitious challenges I think there are out there to try to use blockchain to impact the real world. And if we're able to use insurance as a bridgehead and to unleash the power of blockchain, we'll be able to influence and impact the lives of the people who need us the most, the unbanked, the uninsured, and the unprotected. If you're interested, or if you are excited about this project just like we are, I urge you to kind of like drop us an email to subscribe@lemonade.org. We'd love to be in touch. That's it for me. Please let us know if you want to be part of this. Thank you very much. If we had time for a few questions, I'm happy to. If not, I can drop off, whatever works.
I'll ask the audience, are you able to hear me all right?
Yes, I can.
Okay. Does anybody have a question? I think your presentation was extremely clear. There's a question.
Could you maybe say, thank you very much for the presentation, could you maybe say a word about the pilot that you want to launch in Q3?
Did you have a question?
No, I didn't.
Could you perhaps give a few words about the pilot we're about to execute in Africa?
Of course. So it will only be a few words, unfortunately. But what we want to do is we want to take the biggest risks to this type of project and see if we can de-risk it, right? So see if we can build a product that goes from the consumer all the way through the chain to the investor, and kind of like if you put capital in one side, it goes out the other side and all the way back. Where we haven't decided exactly on which part of Africa will be doing this, West Africa or East Africa. It's going to be Sub Saharan Africa. And it's also dependent on the planting season. So it might be in the summer, it might be towards the end of the year. But it will be a pilot that's its main purpose is to make sure that this is feasible and possible, not so much a pilot that's meant to create scale, if that makes sense. And again, once that pilot is hopefully up and running, we hope to scale that pilot pretty quickly in the same territory to more customers, to more farmers, to different countries, and also to the larger crypto community to allow investment and to issue a token.
Thank you, Ron. I see another question over here.
Yes, I have a question. So I understand like P2P concept and then like how you're like trying to apply to the real world problems. But I have a question like how you apply DAO, like a decentralized autonomous organization concept into this project, because it's usually for like programmers, community members of the crypto asset world to kind of play some roles to reduce costs. But in this case, the end users are more like farmers. So I would like to understand how you apply that concept into this case.
Okay, Roy, we have another question in the audience. It's about how do we apply DAO in a real life, in a real use case. People have heard about DAOs in the crypto environment, so how will this function in this project? How will a DAO function in this project?
So there are I think there are two phases for this, for using a DAO in this type of project. The first phase is that the DAO is basically going to be the risk-bearing entity, right? There's not going to be a different risk-bearing entity other than the DAO. If you think about it, the concept that we're thinking about is similar to Compound or Uniswap. It's going to be a decentralized platform on the blockchain that basically has a risk pool, and the risk pool will be the risk-bearing entity. So there will not be a different company. The Lemonade Foundation is not going to be bearing the risk. The Lemonade Foundation initially will be funding the reinsurance, but it'll be on-chain, and that on-chain capital is going to be backstopping through a decentralized platform, going to be backstopping the insurance policies. So the first instance is that the DAO is actually, this is the way we organize the insurance product, the capital allocation. Over time, and this will happen as we issue a governance token, we hope that the community will be part of the governance of this DAO. So for example, we hope the community will help fund it, fund capital, help be part of the decision-making around how exactly do we price. For example, if we're able to move pricing from off-chain and place it on-chain and allow basically a distributed actuarial model that could potentially decrease costs, make it more accurate. So the second phase of using that DAO is not only as a risk-bearing entity, but as a way for the community to organize itself and to influence and use these decentralized tools to provide and provision insurance basically globally. I hope that answers the question.
Yes, the question is answered. Are there any other questions? I think we have time for one more question. No? Okay. Roy, thank you very much for your presentation. It was very clear.
Thanks so much, everyone. I'm sorry I wasn't able to be there with you, but looks like a really amazing presentation, everyone. I've been watching some of it, and I hope to see everyone soon. Thanks so much.
Thank you.
I do, but it's fine. Hey everyone, my name's Hugh Karp. I'm the founder of Nexus Mutual. I'm just going to give you a bit of an insight into what's coming up with Nexus V2 and what we're working on right now. But just thought I'd just give it a little bit of background on Nexus for those that aren't quite as familiar. So I guess we were one of the first decentralized kind of insurance protocols on mainnet. We launched in May 2019, so that's quite a long time ago in crypto world where everything moves quite fast. But we also presented at the first D1 conference in Cancun in 2017. So great to be back actually presenting Nexus again here. In terms of what we've done, we've launched an on-chain mutual, an alternative to insurance. Basically, people pool their capital together. They decide as a group how to price risk. They decide as a group which claims are valid. And they also decide as a group how to invest the float or the assets of the mutual. And so that's what we've got right now. So we've got a structure that does that. In terms of product, I think at a very high level, our product that we're providing right now, we've had a lot of success with, is essentially protected yield within the DeFi ecosystem. So what you can do is, you put your assets into a compound or an Aave or a Uniswap or whatever, and you earn some yield on that, and then you can come to Nexus and buy protection against the smart contract risk or the technical failure of those systems. And so we've had a really good success with that. We've written quite a lot of covers. We've got roughly about 500 million of cover outstanding at the moment, and like the most popular ones are kind of like Anchor and Curve and Convex and those types of things. So we've got a lot of success within the DeFi ecosystem. And I think I'd describe Nexus at its current stage. It's got capital. It's a functioning system. It's paid out claims. We've got product market fit within a crypto niche, and now what we're trying to do with Nexus V2 from a, I guess, higher level point of view is enable the distribution network. So right now people basically come to Nexus and buy cover after they've gone and done whatever they've wanted to do, put money in Curve or whatever, and then they come and buy cover. But we all know that insurance is sold and not bought, and the more frictionless you can make that process, the much better off it's going to be. So Nexus V2 is all about laying that platform to enable the distribution network to be built on top of the Nexus protocol. It also lays the foundation for Nexus to really get outside of the crypto world. So at the moment we just offer coverage for crypto-related risks, basically because they're our user base and that's what they want coverage for. But we're also, the whole platform is much more generalized than that, and it is going to enable other non-crypto risks in the future. So Nexus V2 is really about creating that on-chain marketplace for risk. It's the next iteration of the protocol, and it does quite a lot of things. I won't focus on, there's a whole bunch of like really nice user aspects to it as well. So we're going to make the claims assessment process much more gas efficient, much more scalable, much easier to use. There's going to be representing cover natively as an NFT, so you can move it around different wallets and all that type of thing. And also you're going to be able to like do all those things that you expect to be able to do with an insurance policy, like change the amount, edit it, increase it, decrease it, extend it, renew it, all that type of stuff. So I'm not going to talk too much about that stuff. I'm more going to be talking about the kind of strategic capabilities that that it's going to allow, and more focused on the distribution side of things. So at the end of the day, what we're really trying to do here is create a marketplace for risk. At the moment, when we want to determine the price of something on Nexus, someone stakes some NXM against that, and then more people that stake lower the price and more capacity. And so it kind of creates like a prediction market-esque type of approach to pricing. What we're going to do is kind of move away from that and have what we're calling syndicates, which also could be for those in like MGAs or things like that, a bit more familiar with the insurance world, where those syndicates actually offer risk or offer prices on particular risks that they feel comfortable with, and they get to choose what the prices are. And so within Nexus, we can have Syndicate 1 saying, oh, I'll price compound at 1.5%, and Syndicate 2 saying, oh, I'm only comfortable with 2%. And so then when someone buys cover, they essentially could buy it from the cheapest syndicate. So it creates that marketplace within Nexus. But moving, so I guess stepping back, what the closest analogy to what Nexus is moving towards is Lloyd's. And there's actually a lot more similarities and differences about what the model we're moving to with V2 is to Lloyd's. But I'll just kind of highlight just the general structure. And if anyone out there are particular Lloyd's experts, please correct me if I've got anything wrong. So in general with Lloyd's, they have different syndicates within there that bring their own capital, usually backed by traditionally the names. And they're kind of like smallish teams that usually specialise in particular business lines or have a particular focus. They're experts in those business lines. And so they bring their own capital, they bring their own underwriting expertise, they bring their own claims. And so they kind of operate as like a small insurance company in their own right. But they are linked across Lloyd's more broadly. And so they're only really linked if there are big problems and they blow through their own capital and they need support and they can't meet their claims. And that's when the Lloyd's as a whole kind of comes in, and effectively there is a linking from a risk perspective. So each syndicate is linked to each other, one through this grouping. And to make sure that all of those syndicates do good stuff and not bad stuff, you have essentially the centralised functions that make sure that the business plans of each syndicate get approved each year, what they can write, how it's going to work, what risks they can take on, what capital they can release, all that type of stuff. And so there's this centralised layer of Lloyd's, which is kind of like the risk management functions to make sure it all kind of works, etc. So with Nexus V2, it's actually, there's a lot of similarities here. We're just highlighting the differences with these slides. And so each syndicate can effectively price their own risk. They bring their own capital. They have to buy, they have to get NXM to actually stake and signal risk. But there is one capital pool that sits across all the syndicates rather than individual pools. So there's a lot more kind of linking there compared to the Lloyd's model. The other main difference is that the sorry, I lost what I was going to say. The other main difference is with that centralised governance risk management approach. Basically, what we are trying to do with Nexus is remove that as much as possible. Some of the stuff's very hard to remove, but like managing correlation risks across different syndicates. But we are trying to remove that as much as possible and let the smart contracts drive it. And so that's all kind of automated. All the reporting's automated. Excuse me. Is there water or something? Someone grab me a water, that'd be great. So yeah, all the reporting's automated, everything's all driven by the smart contracts, and the limits are there. Thank you. So the limits are all in the smart contracts. So what we're trying to do is let these syndicates be as autonomous as possible and be able to write their own business, price their own risk, even create their own products. So what this is really doing is shifting Nexus from a kind of full stack insurer, as it were, to a platform layer where anyone can kind of build on top and white label their own coverage. And in that case, you're kind of managing your own underwriting capital, deciding where to deploy it, on which risks, which products. You're setting minimum pricing that you're willing to accept. You can expand the distribution, and there's the capability to, I guess, benefit from greater economic incentives, because there's also going to be a capability to add on commissions, etc., as you wish. And so there's a little bit more detail here to kind of go through it, but there's a lot more flexibility. One kind of I guess specific, I'll give you two kind of examples of how this might work. Right now, where a kind of simplified syndicate might be someone who is a risk expert in smart contract risk. And so they just come on, they can set up their own syndicate. And what that actually is just a function call on Ethereum, set up syndicate, one transaction, there you go, you've got it. And then you can define which, how you want to allocate your capital, how you want to say, I want to stake 10 NXM against Compound, 20 against Curve, 30 against Uniswap, whatever, and I'll offer prices of X, Y, and Z against each of those. And then if someone buys a cover from your syndicate, then you're responsible, you get all the rewards from a kind of premium point of view, and you're also liable for the claims if they come through. So that's kind of how it works as a simplified version. If you have those risk expertise, you can deploy them as you wish on the products that already exist. Something more kind of full or complete at the other end of the spectrum would be something like a syndicate that has risk expertise, but also has a distribution channel. They have a customer base, in which case they effectively can white label Nexus coverage, add on commissions in there and just add a simple one-click purchase. Say they're a protocol, say they're a Curve or something like that. They can add on a buy cover here once you've deployed assets into one of the liquidity pools, add on the cover purchase, and it directs the cover purchase to your syndicate only, and then you can get commission in there. So you've kind of got this distribution power and economic incentives, leaning back into that insurance is sold, not bought aspect of things. In the future, so from the syndicate operator point of view, you've got additional revenue. You've also got from the commissions, but there's also the capability to effectively, each of these syndicates is a delegated staking pool. So as an expert, I can run a staking pool, decide where to stake, and other people can passively delegate to me their NXM, and then there's a reward share in there that the syndicate operator can choose between different levels. And so the syndicate operator is effectively using their expertise to monetize them, and the people with more capital that don't necessarily have the time or the expertise to do that can effectively delegate that to the experts. And so you can offer those products, and so you can earn from the delegated staking rewards and from the commission revenue that come through the sales as well. And I guess from a big point of view is like, if you're looking to kind of start up a new product or a new distribution channel or something like that, you could actually build on top of Nexus rather than bootstrapping your own capital pool here. So that's kind of an easier way to get started. One of the things that I'm particularly excited about is in the future is the kind of where we can take this. So at the moment, Nexus just looks at crypto risks, but at the end of the day, the Nexus V2 structure and the whole platform is effectively generalized. And you could actually describe it as reinsurance as a service. It's a fully open API-driven reinsurance company, and if someone wants underwriting capital for a particular product or a particular distribution channel that they have, they want to set up their own MGA or their own syndicate or whatever, they can call into Nexus and just write their own business. They could write their own product. They could, if they got their own claims team, etc. So this can be a platform for other insurtechs to build on top of. There are challenges with bridging fiat to crypto and regulation and all those types of things, but there are solutions for those. But the whole idea with Nexus is we're turning from a full stack insurer, and this will be a slow change over time, but turning from that full stack insurer into a more flat protocol, into that reinsurance layer. There's a whole bunch of other, and this is where we can get into real world risks and actually start making a difference. I think we've done a fantastic job, and we continue to do a fantastic job within the crypto world, and there's so much upside there. But I also believe that, for crypto to really make a difference, like we've all been talking about, we need to get outside and we need to offer those risks on real world products. The other main aspect, and coming back to the Lloyd's point, is that Lloyd's has been around for a long time. But one of the things that it really works well at is it delegates the expertise to the edges. It has the decentralized nature. A lot of it is actually in that way. It puts the people that know the risk the best right at the coalface, and it lets them make the decisions. It delegates to them. So it allows, and that's one of the reasons it still remains so competitive, even though it's absolutely horrible from a admin point of view and modernising and everything. People still walk around with paper. You go to central London and you can just see them, and you can just physically go to the desk and stuff. It's just, it's archaic in some ways, but the fundamentals are very, very strong. And what we're trying to do here is emulate that approach, but with a full automated tech stack already there. We want to delegate to the nodes, delegate to the outsides, the decentralized model. We believe that's where the best decisions will get made, the people closest to the understanding, the experts. And so that's really the approach we're building on here, is delegate to the experts and decentralize it, and essentially turn Nexus into that platform that anyone can build products on top of. So yeah, that's a quick look into Nexus V2. You'll be hearing more about it over the coming months as we get to launch. And yeah, really, really excited and looking forward to getting it out there. Yeah, happy to take questions if you've got any. Yep.
You talk about the economic relationship between the different syndicates and the Nexus V2 version.
So the economic relationship between the different syndicates and V2. So there is one capital pool that it's all shared. And so all claims and all premiums effectively go into that capital pool. So there is a direct link. Each syndicate effectively uses NXM as a signal to identify which risks are good and that they want to back. And they earn NXM when people buy cover, and they lose it to pay to offset the claim payments as an incentive mechanism. So it's basically a shared capital pool with an incentive structure on top to write good business. So there is direct link. There is a closer link than there is in the Lloyd's model, where they're actually quite separate, except in extreme circumstances.
How does the claims handling work for a particular
syndicate? So the claims handling, all members can vote on all claims. That's how it works. The way we expect it to evolve.
How do you see that when you have very specialized business, you're a syndicate, you're very specialized, and then suddenly you get people who are not specialized on a particular topic are going to do claims handling?
Yeah, so they can do it. We don't expect them to. So the system doesn't stop them, but they'll get punished heavily if they vote in the wrong ways. So the way it works is, we're seeing this already. Basically, we have an open system where any member can vote on claims, but the number of people that do vote on claims are the experts. They've self-selected. And so we don't stop it, because everything should be members' ultimate discretion about which claims get paid. But the way it will functionally work is people will self-select, and syndicates, especially ones that are writing niche product lines, they will do the majority of their claims handling themselves. But there's always power to the entire membership base to effectively come in and vote one way or another if they wish to, noting that there are punishments and incentive mechanisms to make sure that they do that in the right way. Yep.
What do you think as the powerful syndicate operators in consideration to democratize this kind of system, like operations?
Sorry, I didn't quite get the question.
As a major candidate for syndicate operators, when you think about democratizing this kind of business model in the world?
So who do I think are going to be the syndicate operators?
Yes, strong syndicate operators to,
Yep. Yeah, so I mean, initially we believe the syndicate operators are going to have one of two things to start with, at least one, possibly both. One is expertise on the risk management side of things, underwriting. And we see kind of like, particularly the products we're writing, like audit firms and those types of things are going to have those expertise. We see that as an opportunity to kind of create another revenue stream for them. And the second one is perhaps a distribution channel. They're an existing product, a DeFi product, and they can add on a one-click coverage, and then they can divert some commission revenue to their DAO treasury or something like that. So we believe that the initial syndicates are going to form one of those two types of groups, and they have one of those two groups of expertise. And I think the more successful ones are going to have both of those sets of expertise. Cool. Guys?
The reason why you're presenting this here and together at the conference, is there anything that you want to do together in the future with the Etherisc project, or are there different models that can't be combined?
I hadn't particularly thought about specifically with Etherisc or not, but I think more generally, if this model works, we have a capital pool that a whole bunch of people can tap into. And perhaps that works for some projects that Etherisc is doing. Perhaps it doesn't make sense, not sure, but it's an option that's out there that anyone will be able to tap into. Cool. Yeah.
Is it possible from a regulatory standpoint to sell then insurance products to all kind of countries via this mechanism? Or so you have to, whenever it's called insurance, you have the national insurance laws that apply here.
Yeah, so specifically Nexus Mutual is not insurance, and it's discretionary cover, and so that is what it is. And I think the regulatory environment is definitely, it's unclear. We are where we are right now. Discretionary cover does exist in a whole bunch of places, and that's what Nexus operates with. Now that, can a syndicate operator, that's one of the choices that you want to make. Like as a syndicate operator, are you okay selling that type of product? Are you complying? Are you doing all the right stuff there? That's definitely a question. I think there are definitely, on the other side of things, there are definitely models involved that you can effectively get Nexus coverage and convert it into a regulated insurance contract. You have to put different entities in places and all the rest of it, but those types of things can and are being explored. And so I think in general, DeFi is obviously in a bit of a grey zone with a whole bunch of these types of things. The regulation is very local, DeFi is very global. How do you fit these things together on a permissionless basis? There's a whole bunch of questions. But I do believe there are solutions, and I believe the benefits of DeFi and the way that it deals with the fundamental regulatory principles that are there is very powerful. You've got transparency, you've got full transparency, you've got there's no asymmetry of information, and if you do DeFi properly, there's no agency risk, and those are the two things. That's why you regulate. And so if we can solve the principles of regulation in a different way, then actually trying to achieve the same objectives just with better technology, then I think that can take us a long way. Yes, we have to tick the boxes, we have to go through the processes, and yeah, those things will be done, and different syndicate operators can do that. Cool. Thank you, everyone.
Very interesting insights. So we have a little bit of lunch prepared. We made it through the first block. It's now just a bit over time, I think. So we have about an hour for lunch now, and we'll meet here again at 1:30, which is the block, for the next block. So enjoy your lunch, and we'll see you back here in about an hour time at 1:30.
hey, hey, hey. Hey, hey, hey. Che.
Hi, everyone. Oh, does this work? Yeah. Hi, welcome back, everyone. Thanks for coming back. In the next session, we're going to be exploring on-chain infrastructure that powers decentralized insurance. So you're going to hear from a whole host of speakers, including Christoph from Etherisc, Peter from Munich Re, Asier and Antonio from A43, Andra of Chainlink, and Ray and Jack of Nexus Mutual. So I'll let them introduce themselves and hand over to Christoph for the afternoon.
Thank you so much, Kaylee. Yeah, today we are presenting the next evolution step of Etherisc. And to gauge your expectations, I'm not going to talk about our large projects in Africa with the Lemonade Coalition. That all has been covered by the other talks. I'm going to present our next evolution step, which is staking. And so this becomes a bit technical, maybe, for one or the other, but feel free to ask questions afterward. And so let's dive right into the matter. So where do we come from? We have built Etherisc based on the DIP token, which has been launched in 2018. Then 6 months later, we released the first release of the GIF, the Generic Insurance Framework. GIF is something like an operating system for insurance products, something like a Linux for insurance. And so it provides the basic building blocks and functionalities to run an insurance product. And on this GIF, we created also a new legal model, which is specific for Germany, but also has some implications for other countries, which allows us to operate insurance-like products with a much reduced level of regulation, basically, and which has been approved by the German regulator. And then in the consequence, we have also launched our first products based on the GIF in Africa, Acre Africa, with 17K farmers last year, and the next seasons are currently in production. We have joined the Lemonade Crypto Climate Coalition, and last step, we are currently building also a developer sandbox where everybody in 5 minutes can launch its own instance of the GIF, experiment, develop products. And so what is missing? Missing is one important step in the architecture. You see here, this is the general layout of the GIF. We have a basic layer at the bottom, which controls the policy flow, the life cycle of an insurance. And on the top, there are individual building blocks which can be provided by any party, like product owners, oracle owners, and risk pool keepers. So we already have the first two, the product owners and the oracle owners, for flight delay, for crop insurance, but we are still lacking the third pillar of the generic framework, which is risk pools, and which can also be run by anybody. And this is also maybe a bit of difference, for example, to the Nexus Mutual model, where they have only one big capital pool, which serves for everybody. And we are going a bit more unopinionated approach, where actually anybody can launch such a risk pool. But this is still in development, and so I'm very proud to present today this next step, the staking model for Etherisc and how it works. And to understand how it works and why it's important for us, staking is of course a very common term in blockchain. But to understand how it works, let us first have a look at our revenue model. And this is also, with Etherisc, everything is generic. Yeah? So this is a model which can be used in any product, with any country, with any jurisdiction. It's always the same because it's a basic model of any insurance, essentially. Yeah? Even, I think, in a certain sense, even other projects like Nexus or whoever is basically operating a similar model. Yeah? But let's explain what we are doing here. We have the insured on the left side. He's paying a premium. Part of the premium is simple cost, covering the operating cost and distribution cost, whatever. These are, in our case, we call them sovereign workers, because everybody can engage in this role. Anybody can be a distributor, can be a product developer, can be an actuarial, can be a license provider, whatever. And of course, these people get paid with a certain amount of fee, and the rest is of the premium is then put into a risk pool. And today we will explore how the internal structure of these risk pools look like. And the risk pool is funded by investors who, obviously, they are not doing this for altruistic reasons or just to lose money, but of course they expect to earn money. And they earn money by providing capital and receiving also a revenue for locking their capital for a certain period of time. So that is essentially the model. But now let's have a closer look on the risk pool itself, how it works internally. Yeah, this is what we already have. We have already, with Acre Africa, with our other project, Flight Delay, we have this gray area. So this is already working, and we are soon covering this yellow area with the risk pools. Okay, and of course, very fundamental for the Etherisc platform, all of this is always connected with the utility of the DIP token. What is the utility of the DIP token? Basically, we can name 3 aspects. The first aspect is staking for services. So everybody who wants to earn money on the platform by providing services needs to stake a certain amount of DIP tokens in our platform as a membership fee, you could say. Yeah? So to be able to earn money, you need to have some DIP tokens. Second layer is the governance. This is also for the future, but this will be an important part because every instance of the GIF on whatever platform, be it Avalanche, be it Ethereum mainnet, be it Gnosis chain, every instance is operated by a DAO. And the DAO will have rights to decide, for example, which products can be launched on this specific instance. Yeah? So, for example, if there is already a flight delay insurance, then the DAO could decide that we would not like to have a second competitive insurance of the same type on the same instance. But of course, you could also launch a different instance and launch your own product. So it's not really restrictive, but it's just people who run an instance of the GIF, they should have something to say what's happening on their platform. And most important, the top layer, staking for risk pools, where you actually put your DIP tokens in a risk pool together, maybe with some other assets, stable coins, whatever. But the DIP token will be always an essential part of the risk pool just to make sure that only those people who have actually paid for the development of the whole platform will also be the people who in the end will profit from this investment. And therefore we need to link the usage of the platform to the DIP token via staking. Okay, before we start, let's just have a short look on how a typical insurance premium is structured. Yeah? If you pay a premium for an insurance product, of course you hope that all of your premium will be used to pay out your losses, yeah, in case of a claim. But it is not the case, because insurance is a complex business. You need a lot of people. People need to be paid. They need to get salaries. And you need to distribute the product. This is all cost. This is the yellow part. Then, after you have subtracted the pure operational cost and distribution cost from the premium, you will pay some capital cost for people who provide capital in the risk pool, premium for locking their capital in this pool. And this is the blue part, capital cost for expected loss. And the remaining part of the premium is only used to pay out the claims. Yeah, they are first pooled in the risk pool, but then they are used, and in the average, all claims are paid from this expected loss. And unexpected loss is paid, covered by the reinsurance premium, so the reinsurance will cover excessive losses in case of catastrophic events or something. Therefore, you pay a reinsurance premium. That can also be solved via our risk pools, but that is a different story. Let's first assume that we just have the reinsurance stuff covered. Okay, how does a policy work? A policy works like this. You have a blue timeline, so this is the life cycle of a policy, and in the beginning you pay a premium, $100. And of course, immediately you will subtract some cost from these premium to pay the distribution for whatever reason, operations, whatever. Very simplified here. Of course, the cost can also be distributed over time, but let us keep things simple. costs are $20. Okay, what can happen? In the best case, nothing happens. Yeah, there is no loss, and what happens? The rest of the premium is the profit of the insurance company, or in our case, the risk pool keeper, because of course we have no direct insurance company. Maybe there is a legal entity behind it, but the model itself is generic and does not assume that there is a specific company behind it. This is a positive case. Yeah? No loss, and the full remaining premium is profit for the people providing the capital. The other case is, of course, negative. You pay a premium, cost the same, but then at some time you have a loss, and the loss is, of course, large in comparison to the premium, and you end up with a loss. Fortunately, in the average over many policies, the overall product should, of course, be profitable. Yeah? So we can express this like this. You have a premium, you have cost, and you have an expected loss. So this is the average loss over many, many, many policies. And in the average, the expected loss is, for example, $60, and you have still a profit of $20. And so that is like every insurance works like this, basically. And we will need these small images in the next slides. So let's say we have now a certain insurance product. Now we have a lot of policies, and now we pool all these policies together, and you see these little icons. These green squares are representing a single policy with its cash flow, premium, income, profit, whatever, and now more policies coming in. There is a loss. Okay, it's covered because we have many others. Then another bunch of policies coming in. We have more profits again, more profits. Again, a loss, but it's still covered. So the whole pool still stays in the green, and it's still profitable. Yeah. So that is a positive case. Of course, we also need to look at the other way around. So let's say we have something like a catastrophic event. We have still policies, but even in the first bunch, we have some losses, more losses, still more losses, and eventually, okay, now the whole pool turns red, and probably we now have a phone call with a reinsurance company which will cover this excessive loss. So this is, of course, cannot be excluded. Typically, if the pool is large enough, then it should not happen, because you will have enough profitable policies which will cover the losses. So this is just the background for our model. And now we look into how we represent this model for Etherisc. We have these risk pools, and now we have one crucial step. And the crucial step is that we bundle specific policies, which are, again, these gray boxes. A gray box here, the small gray box, is basically a policy where we do not yet know that it will be profitable or will have a loss. So it's just at the beginning. Yeah? People have paid their premium, nothing has happened until now. So we bundle these policies into certain bags, and each bag is represented by an NFT. NFT is a non-fungible token, a very versatile instrument on blockchain, where you can actually link a specific asset, you can link a specific data set, you can link a certain set of policies to one specific token, and this token is represented by a standard, and the standard makes it very easy to handle this. Yeah, there are libraries, software, smart contracts, which make it very easy to deal with these NFTs, and all of you know these bored apes and these little JPEGs which you can use for your Twitter profile picture and so on. So these NFTs typically are static. Yeah? So once minted or created, they are fixed. They never change anymore. But there is also a different type of NFT which can change its content during its life cycle. And this is what we need here, because an NFT, for example, for flight delay, would be an open NFT, which would take all the policies which come in over a certain period of time and would digest them and bundle them. And we do not know in advance how many policies are bundled in this first NFT. These NFTs can be bundled by various criteria, either by time, all policies which come in 2022, all policies which are covering flights from Europe, all policies which are covering flights in Latin America, all policies which are covering Lufthansa flights, whatever. Yeah? So there are many different types how you can bundle these NFTs, and it's completely open. It's up to you as a product designer or risk pool designer to create the criteria for these NFTs. Now, you bundle these NFTs, and now you can link this NFT with a certain capacity. A capacity is basically a specific number of assets or collateral which covers the losses of these specific NFTs. And in this case, for example, we have 100K for the first NFT, $200,000 for the second, 400,000 for the third, and 400 for the fourth. And each of these pools or each of these NFTs has a specific capacity, which is defined by people who create these NFTs. And of course, after we have provided this capacity, we can then start selling policies, yeah? Because every policy needs an existing collateral that you are able to sell it. You cannot sell a policy if you have no money in your bag. So first, create the NFT, provide it with capital, then you can sell policies, bundle them in the NFTs, and so you have now these bags of NFTs, and you can see there are also overlapping NFTs. Yeah? So this policy in the middle is covered by two different NFTs. Yeah? Both provide capacity proportion to the capital locked. Yeah? For example, in this case, the NFT number 2 provides 200 and the NFT number 3 provides 400K. So one is 1/3 and the second is 2/3 of the capacity of the risk. And also the profits and losses are distributed according to the ratio of these NFTs. So that makes it also very flexible. You can cover a policy by multiple NFTs. Okay, so this NFT now has a specific value because you can calculate it. Yeah, you have, of course, the assets which are in the NFT as a collateral, and then you have the actual happened losses and profits and the calculated profits. Yeah? Some policies have already expired, you have a profit. Some policies have a claim, they have created a loss. And some policies are still running, they have an expected profit. Yeah? And this can be calculated based on standard insurance mathematical models. And so an NFT always has a specific value. So it's a financial asset, and you can sell it, you can buy it, you can trade it, and that makes it very flexible. But you have a problem. These NFTs are very specific. Yeah? They have a specific number of policies into it, and so it will be not easy to find a buyer for these NFTs or somebody who will provide capital, except you have a very specified investor who exactly wants to have these type of policies. Or, for example, my standard example is maybe you have insurance for oil platforms. Yeah, you have 10 oil platforms worldwide which are covered by the risk pool, and then you have an investor who says, I want only these 3 oil platforms to be in my NFT, and I will provide cover for exactly these 3 policies. That is possible, but probably it's not the usual case. The typical investor wants something which is tradable, yeah, which is fungible, which is can be put on an exchange. And so we need another step. We have first, of course, we have this primary risk pool with the NFTs. And then we need to make these NFTs fungible. And this is also a standard technique on blockchain. If you have a bunch of NFTs, you call it fractionalize them. You can put them again in a bag, and then you can sell the bag or pieces of the bag via standard ERC20 tokens. And this is what happens. Yeah? So we put these NFTs in a secondary risk pool. Now we have these NFTs in one secondary pool, and this pool cannot now be sold to investors. The investor puts in the money, DIP tokens and stable coins or whatever assets he likes, but in any case he will put in DIP tokens. Then he will receive fungible risk pool tokens. These are standard ERC20 tokens which can be traded on Uniswap or any decentralized exchange. And then this collateral will be routed forward to the primary risk pool and provides the collateral for the policies. So by this trick, we have fungible risk pool tokens which represent a specific set of NFTs which have been created from insurance policies. And this model is very flexible. It can cover any type of structure, any type of policy. Of course, we can also have a very simple system where all policies are one NFT. We can build this model as we want. In reality, it will work from the temporal development. It will work the other way around. First, we have the investor. The investor provides capital. He receives the RIP, the risk pool tokens as a tradable token. Then we put the collateral in the primary risk pool. We create the NFTs and put the NFTs in the secondary risk pool. Yeah, that is the sequence, how it will happen in reality, because you need to do it the right way. Yeah, so first provide the capital, then invest the capital in the primary risk pool, create the NFTs, and everything is fine. But that is just a matter of how the sequence is. Okay, now that is not the end of the story. Now you can combine different secondary pools with different primary pools. Yeah, so you can cover one primary pool with one secondary pool. You can cover two primary pools with one secondary pool. You can cover one primary pool with two secondary pools, whatever you like. Yeah, so it's an open, it's a generic framework as always. So you can build any structure you like. You can, for example, you could build something like the syndicate, what Hugh mentioned, yeah, the syndicate system where you have syndicates, people, experts who invest in specific risks. Everything can be done with this model. And I think we were also asked what is the difference between Nexus and Etherisc. And to put it in simple words, I would say Nexus is very opinionated on how they do things, and I think obviously they do a great job how they do it, but they're very opinionated. They have one risk pool and one capital, and everything is built on top. We are not so opinionated. We are very generic. You can choose what type of structure you like and what fits best to your purpose. So we are not that opinionated, and I think that makes a bit of the difference. And of course, both can be combined. Yeah, you can, of course, also link a Nexus pool with, for example, some intermediary layer to a secondary risk pool on our side, or you can integrate reinsurance by Nexus with our products, and so on. So no limits to your fantasy. This is the nice thing of blockchain, that things can be composed. Yeah, composability is one of the big assets of blockchain in general. Okay, come back to the original model. We have the existing part. We have now seen how staking works and how we implement the tokenized risk pools. And of course, how the utility of the DIP tokens works in this context. And yeah, that's all for today. I'm open for your questions. Thank you for your attention. Yeah.
Why do you have to use NFTs? Because I mean, other cryptocurrencies in general already has like some assurance for the flows to happen because it's a community. So like, could you please explain why?
So the question for our online audience, the question was, why do we need this specific layer of NFTs? Why can we not just simply use fungible token? Of course, we have also explored this, but we found out that we need this layer because we do not know in advance how the structure of the risk pool will look like. Yeah? Policies come in, they are sold, more or less. Policies can have very specific features or properties. So an NFT is the ideal instrument to cover this complexity of the risk pool. And then we go the second step and we fractionalize these NFTs in simple tradable risk pool tokens, which can then be as any RSC20 token can be traded on an exchange. More questions? This is not the case, then thank you so much, and I can hand over to my dear colleague. Where is he?
Christoph, one more question.
Yeah?
Typically, what type of investors will be the ones that Etherisc will be reaching out?
Sorry.
The investors, what type of investors are the ones that Etherisc will be reaching out to buy the NFTs?
Yeah, that's, it depends on the type of policies and the volume what we are talking about. Yeah, for example, if you are insuring an oil platform, you probably have policies which need a lot of capacity in the millions, and probably you need very specific investors who are able to provide that capital. But if you have, for example, our flight delay, yeah, where we have, for example, all flights from Lufthansa, all flights from KLM, maybe this specific NFT, which you could create for the specific subset of flights, would be cheap enough for a normal guy to put some $100 or $1,000 into such an NFT. Yeah, that would be possible. Specifically, if there are others who are adding capacity, because you have seen the NFTs can overlap. Yeah, so many people together can provide capacity for the same policy by just sharing the same risk.
I'm trying to understand the concept. So, can an NFT be negative, or is it not possible because of the risk pool before?
So the NFT has, of course, a collateral, and the collateral can go to zero, yeah, in the extreme case of a catastrophic event. If the product is structured in a way that we have, for example, reinsurance, then the reinsurance would then jump in. The NFT would not go below zero. It cannot go below zero, because then the reinsurance would cover the rest of the losses. Yeah. Okay. Peter Bärnreuther, Munich Re.
Thank you. Müsste noch meine Präsentation. Peter Bärnreuther, I'm working for Munich Re. I will today present you our approach to crypto-related risks. So especially I will focus on how traditional insurance and fintech or crypto tech can work together here. To myself, I'm with Munich Re since 10 years. I'm an actuary. I'm holding a PhD in physics. This is my opinion. I didn't go through group communication to check everything, so even my team members might have a different opinion in it. So take it with a grain of salt. Perhaps if you don't know Munich Re, we are quite an old company, really a TradFi company, 140 years around. And we are a reinsurance company, so we reinsure other insurance companies, meaning as well that we love to work with primary insurance who's in the space. We are about 10,000 people, which sounds a lot, of course, but it's really little if you compare to other large players. That's because we really are not, we are the reinsurer who's behind them and give more capacity. From our annual report, I took this line. We provide coverage for extraordinary risks such as rocket launches, renewable energies, or cyber attacks. This was, I think, page 2. I hope in 2 years we can write there and crypto-related risk. To our team and our commitment, we have really a strong commitment, which was a grassroots movement. So a lot of people in different departments are personally interested in this topic. So we built up a team, and now an official innovation team within Munich Re. We have as well board commitment, and we are one of these strategic innovation playing fields. So there's really attention as well as on crypto from the board level. And our approach is we look at everything which is crypto related, but of course as well crossing the river by feeling the stones, going step by step and learn on the way. So what we are doing, the first which we take on is the custodian risk. Basically you lose funds because you have your money within custodians. I think Mt. Gox was the most famous one which we had. And there you're losing your funds. And we are working here with technology providers, and but as well, which you would know as well with the large custodians. We could close in the last 12 months several deals. 2 of them are public. First is Curve, which is basically a technology provider for this MPC, multi-party computation. And the other one is D1Conf, which is a very small, it's a small insurance startup in Hong Kong, but they really could convince us that they have superior knowledge in evaluating and doing the risk assessment for these custodians' risk. So we gave them capacity. And the second pillar which we have is smart contract. Everybody who use DeFi has, I think, some experience on it. I will go a little bit more detail in two slides. You put money into a smart contract and this is hacked or the money is frozen. You don't get it out. Here we partner as well with companies where we think they have exceptional risk know-how, and their partnership will be hopefully announced soon. I cannot reveal it now. But from our end, we have the wording finalized. We know our risk appetite. So if you want to insure a large chunk of your DeFi, Munich Re is definitely an option. Of course, our main trouble here is really how to partner with this DeFi protocol. So we are, of course, Hugh is an ex-colleague from us. We are talking to us. We are talking to others as well, but really making deals with DAOs, we didn't find a way. If you know some, please come up to us later. This is really the most trouble which we have there. Another column is slashing risk. In these proof of stake blockchains, you have validators who are building the new blocks, and there's a risk that you get slashed if you do something malicious, but it might be as well that you just be offline or you do a double signing by accident. So all these validators are concerned with the slashing risk. This is as well something where we see a lot of market demand, and we are looking currently into it. And as well here we are looking for and exploring this risk and looking for people with a lot of knowledge here. Other bets, that is really why I love this crypto initiative so much. So there's so much coming up, like NFT storage insurance. Yeah, if the NFT gets deleted by accident, this is something we are looking into it. Or, for example, miners are approached by family offices who want to buy Bitcoins, but they must be green Bitcoins, so mined by green energies. So the miners are facing the problem if the price for the renewable energy goes up and the Bitcoin price down. Yeah, and they are looking for solutions in these areas as well. I think there's a lot of tech E&O, also so errors and omissions in this crypto sector is asked for. So we are looking at the moment of everything, very broad, but of course we have to be selective. So these are the 4 buckets basically which we are looking at. There's of course a lot of old risk with some small crypto components. Like if you're a mining company, you have your property risks that your mining company just burns down. But I think this is too traditional that we look into it as a project. And perhaps here only to give you a flavor we are doing, or this I'm personally doing to get a little bit into the space, and here a short deep dive in the smart contract risk. So we or myself mainly were analyzing 107 all basically smart contract exploits in 2021 in depth. And there were, of course, much more, but I didn't analyze every Binance chain rug pull. And then we really looked into and we tried then to cluster it about, are they insurable? So there are a lot of like rug pulls, it's not insurable. Phishing attack is not insurable. Oracle attacks would be a difficult one. Then I think BetcherDAO was a great example because the smart contract, there was not an error in the smart contract, it was really in the front end. So is this insurable? Probably not. So we looked at which of these hacks could we insure? And then we did here probability analysis. So what is the probability that a smart contract gets hacked? And then the severity. So if it's hacked, how much of your funds would you lose? And if we look at the Ethereum chain, because it's the major or the most major chain, we would say from a randomly chosen protocol, it's like 6%. So it's like 6% sounds quite high. It's 1 of 16. So much protocols got hacked. So it's more. It's on the one side a high number, on the other side it's a low number. On the severity side, this was super surprising for me when I saw this. On hindsight, it makes sense that you have a lot of protocols, you lose almost nothing, only 2, 3, 4%, and a lot of protocols which are then hacked to 100%. Again, this is only it's from our perspective, only the insured ones, or where our insurance cover would attach. Yeah. And what you can see as well, if you're a small company, so with your TVL is quite low, then it's basically always 100%, yeah, that your whole money is gone. If you're a large company or a large protocol, you have a large total value locked, then the probability is quite high that only a few percent of your funds is gone. What are open questions and which we are investigating, but as well looking here for other opinions. For example, what is the impact of an audit? Yeah, it should reduce the probability that it's getting hacked. But to really see it in the data, it's really difficult because you have to see which version was audited, was this version deployed, would the hack would have happened as well with the audited version. So there's a lot of work to be done. Or what is does the experience of the team or that the team is stocks, does this have any influence of the probability that is hacked? So just there's still a lot of open questions to come really that you can really determine the expected loss of a protocol. Yeah, I'm often, but this is a totally different slide, I'm often asked what is an insurance perspective on all these companies, on the protocols. Again, this is my personal opinion. I try to cluster the companies which I see. I don't know if I did a very good job there, so perhaps your opinion is totally different. And as well, we are talking to a lot of the names which is here in the protocol, but not to all of them, and sometimes we had only one call, and I might have totally misunderstand the business model. So let's take the first one. I call it the Ubers because these are the decentralized platforms for new risks. Here it's quite crowded. Yeah, we see Nexus V1, Insurance, Tidal, Ensure, Harbor, Unslashed, more than I can say. It's of course a great space to be in, but only 1, 2, 3 protocol will probably survive. And be the platform for new crypto risks. Then we have, I call them the hippos, you could call them perhaps as well the lemonades, which are concentrating on the old risks, but where you would ask them, what is your main USP? It's the operational efficiency. Yeah? Where you say, hey, we are a little bit like a TradFi company, but we are much more efficient. And the platforms would be, there are platforms like Names or Insuro, but there are as well other companies. So centralized parametric insurance, I would put into this bucket. Then Moonbird. So if you don't know what a Moonbird is, you haven't been on Twitter the last 3 days, or I'm following strange people. Basically, it's the new Bored Ape or the new CryptoPunks. And these are the centralized new companies which are doing these new cryptolized. Like Munich Re, which we partners, one which I cannot announce yet. But I would like to see much more companies here. I don't see so many here where we say, okay, we have the risk capabilities to evaluate this risk and have a new centralized company we can do a reinsurance contract with. And then the dinosaurs, the CryptoPunks, that's we centralized, old-fashioned TradFi company, which are looking for new risks, where I see, except us in the custodian business, I see Lloyd's. Otherwise, not much. And that's okay. We don't have to change this. So what is in for you? We are looking always for partners with exceptional risk expertise, which have solved the distribution problem, which have a profitable business model, which is always hard for us if you don't know what KYC is or AMM. If you are DAO, it's really tough for us to work together with these kinds of protocols. So that's from my side. I'm open for questions. Any questions? I scared you. Yeah.
So, Peter, in your view, how should companies decentralized or centralized solve the capital problem in DeFi? So these risks are, we only have a number of years in terms of data, and we can analyze those 100 or 200 cases a lot, but it's still just 200 data points. How much capital needs to be there to ensure the claims are properly paid out? And on top of that, how can we ensure that that capital can be used to generate enough yields for the capital providers?
Yeah, it's a very good question. I mean, in DeFi, I think we have had some data points at least. Yeah, it's not too bad. More research has to be done there to really get a better feeling here, but basically our approach is crossing the river by feeding the stones, so step by step giving out smaller limits and then in the next years to increase it. That's basically how we going forward. Yeah.
So thank you for the presentation. So you are Munich Re is a dinosaur. This is how you named yourself, I think. And I think you sit on a lot of data, and you mentioned that you would like to interact more with the DeFi space. So I was wondering, what type of data would you like to put on-chain in order to interact with DeFi? How do you see these partnerships?
So what we are looking is basically if some companies like Munich Re, I think it's a good example, which convinced us, they have really great knowledge and risk assessment of certain custodian business, and then we can make business, we can give them our capacity, they can write much more than they could have written without us, and so we collaborate on a very traditional way. Yeah.
Would you put your capacity behind such projects like Etherisc or Nexus Mutual?
And that's a
buffer the high you know what I mean.
Of course, we have to analyze it. Yeah. But I think a very good question is as well: would we stake on these platforms? And would we stake on these platforms? Yeah, like Etherisc or Nexus, and we would love to. This was the first basically idea which we had. The issue with Nexus is that they are going full DAO. We cannot. There's no KYC. Perhaps we pay out to a Russian oligarch, which we don't want to. and we don't know. So this is our main problem. But staking is for me basically collateralized reinsurance. We are buying cat bonds all the time, investing in them. So this would be very traditional for us to use these platforms for staking. We are into it. we can know, yeah. Yeah, we can, but it's difficult for us. But I think if there are these opportunities that we can say, hey, there's a risk which we really like, it would speed up things. Yeah. But we got now our MetaMask and.
But you would step into a trial, into a project, to find out how to.
Pardon?
You would step into a project, into a trial, to find out how to proceed in such a collaboration, using token, for instance.
Yeah, for Nexus you have to need this NXM token. Yeah, this would be possible. Yeah, we would as well here start with a small scale, stake it, but here it's all of them basically are decentralized. There's no KYC, and then it's from compliance perspective for us not possible.
Yeah, but is KYC Christoph, isn't that the case?
I don't know for Etherisc. I don't know if you have.
Our DIP token is fully KYC from the minting, from the original minting. So we can provide DIP tokens which are clean, which have never been traded, which are where we can prove every the provenance of the money to the detail and on a level of Swiss KYC. So that is possible, but I think the problem is more. Your financial accountant will ask, where shall I put that token? Yeah, is that a security? Is that they have no drawers to put the token in their balance sheet? And I think that is something what needs to be solved. That the accountants know how they can handle that in their balance sheet.
We are solving this problem right now. So we got some money on chain now, but for us the problem is if we pay out. If we pay out, is this person KYC'd? Yeah. This is a must be, and this is for most. There might be others, but for most it's not the case. There was another question. Oh, yeah.
Thinking about the product you showed in insurance against a smart contract, I'm myself asking, okay, is there actually a business case behind that? Because if you say 6% break at some point, this also already gives me quite a high premium when I think about it. And then we have the case that either the loss is so minimal that probably going through the claims process is not worth it, or on the other hand, it's such a total loss that probably your policy pricing is going to be rather high. So is there actually a business case for both the insurer and the person who deploys the smart contract, who manages the smart contract? Or is it basically going to be so prohibitively expensive nobody can actually use it in production?
Well, currently we have like the 6% probability and a little bit less than 50% severity. So your expected loss would be like 3%, but this is for a randomly chosen protocol. So we hope that the Aave and compounds of this world, where we won't start with, are doing much better. But this is really the ongoing task which I have as well. Okay, what is the difference between an audited protocol and a not audited? And there should be some, but I don't have it yet in the data because I don't have the necessary data. But this is, I think, a research which the whole community has to do and is doing at the moment.
What's the easiest way to reach you for partnerships?
Just come over later, or my email, I think my email address is included on the website, or Bärnreuther@munichre.com. Yeah. Okay, thank you.
So before we start, maybe 2 questions to the audience to check if this is the right audience. So first one is like, please raise your hands if you not hold crypto. Okay, as expected. Second question, the more important question: are you feel sometimes that it's a bit risky to hold crypto? Please raise your hands if this is the case. Okay, I see some people feeling it what I feel too. So welcome. My name is Antonio. That's Adi. Together we are A43, and for the people who hold crypto and as well feel like a bit risky, welcome to the ship. Because that is where we are at the moment. We are so we are all interested in the crypto space, and we are all shipping in the same boat. And I have to say, in the last years, the water was a bit volatile. Looking to the market cap, looking into the TVLs, or as well as Peter mentioned, the complete hex. I don't know where I feel sometimes a bit insecure of holding the crypto as well, looking now into the new regulatories. So that's what the next 15 minutes are about. It's like how we can handle risk in this environment. And then as we see our ship here, it's like on the one side we have the waves. On the other sides we have as well our icebergs. We call it riskbergs. We will come later to this. And how we're going to go into the topic. So we're going to tackle the topic like in three acts. The first act is more about how we gonna, why do we need this? So what's the context? Then I will hand over later to my colleague Adi to describe it's like how we want to tackle this, to understand which kind of risk we have, and as well what's important to understand how we control the risks. And last but not least, because we are all in one ship, how we're going to collaborate in future, and we need your help. And as well, if you're not in stormy waters, as you can see here, and we are in flat waters, we have as well our icebergs here. So actually it's a quite risky business where we are in an uncertain business. And looking only into the last news, we just been down some kind of a snapshot of the last news. And rather I am in the DeFi space, I like tackling stuff like bridge hacks, or what Peter said, the Mt. Gox, or I have issues with my wallet. Funds are kind of like blocked from a staking pool where I am in, or maybe in the next 2 years, maybe in Europe, the MiCA and the DORA regulation will have placed. What does it mean for me? And as well, not only me, but as well like the organizations, the crypto native companies are as well like feel the risk as well. And that is where we want to go in. So besides of us who are like trying to maneuver through this water and have a look on the icebergs, it's like we just want to survive, and we want to build as well something what is more sustainable, and where we are all like more risk advice on it. On the other hand, we have as well the Munich Re's here who want to be as well into the game and need support, and as well see an opportunity on the one side, but on the other side they see a lot of risks. And they maybe want to come to us into our boat, but at the end they are like, I don't know what's going to happen. Do I need to go to the jail because I'm an Ethereum developer or not? But that is where we are at the moment, and that's our goal, to understand like what are the risks and actually how we can handle the risks.
So before we go on to the next slide. Unfortunately, I can't move there because there's only one microphone.
Should I?
Yes, please. Thank you. So before we start the next slide, we just kicked off this project actually, and it's thanks a lot as well to Etherisc to provide us a grant for kicking off this project. So as you may know, there are a number of tools in the market, products, tools that help you assess and even transfer some of this risk in DeFi, right? But these tools are mainly focused on the technical part, or also on the financial part. So what we are hoping to do is something that's a bit more holistic, right? So we want to create a holistic open source framework for organizations to be able to manage their risks and controls, right? So these should cover not just technical and financial risks, but also the non-financial ones. For example, like reputation risk or risk of your resources or your devs or people in your community. So that's the first part. So it's something like you can think of like a generic risk framework, right? But that then brings us to our second point. So generic risk frameworks are good. They're like a foundation, but they're not enough. And that's because when you have different organizations and different contexts, the weightings of those risks, the profiles of those risks are different, right? So you might have a group of applications or protocols that they are very similar and do similar things together. Like they can be liquidity providers, for example. So they might have weightings that are more similar than like a gaming protocol on DeFi. And then our last goal is that we want to contribute to growing the risk and controls community in DeFi across protocols and across network. That's really important for us because I think there's a lot of, like Antonio showed, there was lots of stuff happening, lots of hacks, all of this stuff. But I think if we can work together and see how we can manage those risks and control those risks, I think that will help make the boat a bit safer. So following that, the main driver for us, the main question that we're trying to answer is how do we divide and share risk in DeFi, right? So for that, we need to understand what those risks are and to also be able to quantify and qualify those risks, right? So for example, by being able to see all of the different types of risks that certain organizations face, we can also try to start to understand how the risks correlate to each other, and then what kind of controls can we implement that cover maybe just one risk or on multiple levels of risk, right? In addition to that, so we also want to be able to associate risk metrics to this risk in an easy way, right? So this is draft, by the way. So from the risk taxonomy or the risk architecture, where we outline, say, kind of like high-level risks, then go down to their subtypes, right? We want to be able to then link those risks with the Web3 layers, right? So maybe some of those risks sit on the blockchain network level, but maybe some of those risks are more like DeFi protocol level, or even just a risk that sits on the liquidity pool. So those are all different, those might be called the same risk, but they are different layers, and so they might have different metrics. And if we can associate it with different layers, then we can pull on-chain and maybe even off-chain metrics more easily for those types of risks, right? In general, the framework is supposed to help you be able to divide your risk. So if say you work for a protocol, you just started like a protocol, you don't have that much TVL, which as you saw in Peter's presentation, you might be hacked and lose everything, right? So you want to cover your risk. And in that sense, you would want to say, okay, I have IT risk. How can I break it up? Maybe the smart contract risk, I can cover it with this insurance. Or the front end, I can cover it with this insurance. And maybe my dev risk, I can cover it with a certain insurance, for example, right? It helps you divide those risks and put different kinds of controls or risk transfers to be able to manage overall your risk portfolio. So that's our idea. The other thing that we are also looking for is like, how do we help organizations also look at the less financial kind of risk, right? So these are things like reputation risk, or and these are things like personnel risk, right? So we've talked to a number of different players in DeFi. So we've talked to protocols, we've talked to regulators as well, and everybody has like a kind of like a horror story of something that bad happened to them, right? And not all of this is because I lost the money in the pool, right? Some of this that we heard is, oh, I got kidnapped and someone ransomed me. So then we said, oh, don't you know there's a kidnap and ransom insurance that maybe you could get? So these are kind of things that are actually could be useful if you are, say, starting a protocol or you already have one and you just want to understand what are all the risks that could happen and how do I manage them, right? So then, next slide, please. Thank you. So, like I said, we are just starting out. So we are still in the early design. So it's the first phase of our project. The idea is that we're going to publish the first draft of our framework. So we will be very happy to get your feedback and comments on how we can improve it. And we also really want to work with organization protocols, with enterprises, with regulators, on how we can build like a good framework and also maybe implement those frameworks to have kind of standards that apply to different types of organizations and contexts. So thank you very much, and we hope to work more closely with you guys in the future. Thank you.
Any questions so far?
Do you have experience launching protocol or managing protocols yourselves?
We don't have experience launching protocols. We're looking more at supporting protocols to help them, from a risk and controls perspective.
You would be then have an advisor role, or how would you see yourself there?
So at the moment with this project, I think we wanted to start an open source project, right? A community project, and work together with all the other teams that already exist that are looking at risk, right? And the idea would be that we would be the main contributors to push this project along to get the framework to a certain level, right? But it's more looking at like a community project. And with working with protocols and stuff, I think it really depends, right? In the end, it's an open source project. Those protocols can take this framework and apply it for themselves. I think big protocols already have risk teams in their DAO that could do that if they wish to. But we could also work with them to apply it to their context and see whether that is useful or not, right? Because in the end, it's good to have a framework, but the most important thing is, does it actually help? Is it useful? Does it actually help you to manage the risk, right? And that's what we want to know. And that's the kind of framework we would like to build.
And that is as well what we experienced when we talked to the protocols. They most likely said, yeah, we have a dashboard. We know how we can analyze the risk metrics, but what should we do? So what is a good control for us? This is something what, it's a question mark for us at the moment. That is where we need more support. And that is what we want to build, like a more community-driven metrics and a framework what can live. And as well, if you are, for example, a company, we will start as well with kind of like a supportive role to explain you how to go into the space and what are your risks when you want to onboard.
So we're also looking at enterprises who want to get into DeFi, right? But they're kind of like scared or not sure how to manage their risk there, because from the outside it looks like, what the hell? Why would I want to go there, right? Aside from the opportunities presented. I think being able to help their risk teams see what those risks are and be able to understand it in a kind of easy risk framework, that helps a lot for those enterprises to understand how much they want to step onto the boat, for example.
Question to your number 4, when you're saying you already think about regulatory and compliance frameworks. I assume you're Germany-based, so would you start building your framework based on the risks mentioned in the VAIT, or are you taking like a global first approach and try to slot the very different local risk assessments in later? So how truly global or decentralized is your framework going to be, or what are you planning?
So at the moment, we're looking mainly at the EU level framework, so like MiCA, DORA framework. Those are what we are looking at. So we think it might be a good idea to maybe work with some regulatory sandboxes or something like this, right? And start off at the EU level, not specifically Germany. But we're open to like whoever wants to collaborate with us, right? EU just because we are here and it's easier. If there's no other questions, then thank you very much for your attention and time.
Silence, please.
Hi, hello everyone. I'm not sure if, yeah, you guys can hear me. Great. Hi, my name is Andra Maute. I am representing Chainlink Labs together with my colleague Josh. He's our community lead. Today I'm going to talk about decentralized validation for parametric insurance. I'm very happy to be again between people. To my person, I'm a technology strategist. I love technology. I studied computer science and electrical engineering, and I have a background in financial services, also a passion for insurance. And a fun fact about me, I live in a country which is overinsured. And today I'm going to talk, like a lot of you guys, about the underinsured world. So I live in Switzerland, where 22% of the salary goes to insurance. 22% overinsured. Prepared for everything. So my presentation has three parts. What is Chainlink Labs? I'm going to talk a little bit about our company, and I'm going to show you how the end-to-end parametric insurance products look today. I think we talked about the puzzle pieces, but I'm very eager to show you a slide where we put it all together, and how we are also making it happen nowadays, every day. And last but not least, we are very proud to be here. We are very proud of the partnership with Etherisc, so I'm going to talk a little bit about that as well. Yeah, but before I start, I would also like to know you better. So who knows Chainlink Labs? Wow, impressive. Okay, very good to know. And I'm also curious, who bought already a parametric insurance product? Okay, so not so many people started to fly again. Maybe a flight delay insurance would be good. But yeah, let's, even if you know Chainlink Labs, I would be very happy to give you a short overview about who we are and how we are also trying to change the industry and how we are trying to create new products for new markets and especially for emerging markets. So our vision is to build a world powered by truth. Maybe you heard about this. Our CEO, Sergei Nazarov, is very clear about this fact. And this fundamental belief comes from the fact that we know that cryptographic truth is much bigger than trust assumptions. We know that cryptographic truth is deterministic. We know that cryptographic truth is data-driven, is secured, and we know that trust assumptions are based on paper contracts, are based on asymmetric information. So, yeah, has a couple of pain points there. So, with this vision that we are working every day, we are also able to formulate our mission and then act upon it. Our mission is to build decentralized systems that are linked only to truth and create unbiased and unbiased services. So how do we do this? I think that you all kind of know by now what smart contracts is, what smart contracts are. We are basically a middleware that connects enterprise systems, any system with smart contracts on public or private blockchains. We are not a network provider. I think this is very important to understand. The nodes, the Oracle nodes are operated by companies like LexisNexis, AWS, Telecom, Swisscom, and so on. So we only provide the open source software for the Oracle nodes that is basically bringing the off-chain data to the blockchain world. So, yeah, this middleware that we created and that enables the interlink between the two worlds, I think it's very important not only for the DeFi world. We will see that more and more enterprises will adopt the so-called enterprise decentralized Oracle networks, because also enterprises want to become faster, want to improve their time to market, and it will be bit by bit, we will come to a race where we will have, also in the enterprise world, we will have to deliver much faster. The processing of the claims will have to become more transparent. So this adoption also in the enterprise world of the so-called add-ons, enterprise decentralized Oracle networks, is a critical infrastructure, critical middleware that is needed in order to perform in the digital world, in order to not be considered anymore to be a business that operates on fax machines. We all know by now that blockchain technology is enabling us to design secure parametric insurance products, and I think we are all looking at this market because not only because it's big, 50% of the issued catastrophe bonds 100 billion market is pretty big, but we are just seeing, like today, everyone said climate change is here, the natural catastrophe events are really happening and more frequently. So there is a need for liquidity, much faster liquidity. If I think back of the events, the hail events that we had in Europe last year and so on. So more and more we need to be fast with the solutions that we create, put on the market. And of course, we now understand that with the help of the technology, we are able to create new markets. I'm thinking of emerging markets, so Latin America, Africa, Middle East. There are a lot of underinsured or uninsured population, people out there, and the gap is immense. We talked about it. We need to close the gap. At the same time, what is so interesting about the technology is that the smart contracts and about the technology is the fact that everything is deterministic. We are able today to basically write an insurance for any data point that we have on this world. It's incredible. This was not the case before. And with such precision and with such a timely delivery of a payout. So I think this is the opportunity that we are all looking at. The cost, the operating costs suddenly go very low, and it's interesting to look at these use cases, of course, end to end. We talked about Kenya today, and this is also my persona. It's a person that is living in Kenya, has a mobile phone, has an M-Pesa app installed on it, takes out the app because the person was advised by an NGO employer, buys a policy, a crop or a flood policy. The person is registered in the smart contract, and then a lot of magic happens in the back. What is that magic? So we have the data providers here on the right side. We have here the Chainlink nodes, the decentralized Oracle network, and we have here monitoring services that are also provided by Chainlink. Chainlink Keepers is one of the services that allows us to constantly monitor the data feeds that come from the nodes and then assess if the smart contract needs to be triggered or not. So this is the tech piece. Here we have a lot of data sources, right? Benson talked about satellite data, we have temperature data, we have rainfall data, we have IoT data, right? We can have sensors in the floor measuring the moisture of the oil. We will have a lot of sensors around us, right? And once drought was registered, once very high temperatures for several days were registered, the smart contract is executed, the payout is triggered, and the person gets right away its payout in the wallet of the M-Pesa. I think another nice example that we are also enabling is the flight delay insurance that you probably also familiar with. So you, as a person at the airport, buy a flight delay insurance in order to protect yourself and get the cost back of probably missed a very important meeting. And how is this happening in the background? The air traffic flight data from Chainlink is the weather data all is assessing the smart contracts, and then if a delay happens, the payout is triggered. Same pattern. Now, I told you we are very proud of the partnership that we have with Etherisc. This partnership started a couple of years back, and this year we announced the launch of a joint grant program, which is supposed to support the adoption, the blockchain adoption in parametric insurance area, and should support the projects that are built on the GIF that was presented earlier. And of course, Lemonade is also another project. Lemonade Crypto Climate Council is another project that we are working together with all the partners. Hannover Re, Pula was here, Tomorrow.io, DAO Stack, and this project is being developed on the Avalanche blockchain. So I think that you guys could involve with us, by contributing or creating one of the projects with the help of these programs. But there is more to it. Our community, our developer community, is the second largest after Ethereum. I think that we are doing a lot of education. We have a lot of hackathons. If you want to talk to us, if you want us to make you successful, just come and talk to us. We are very interested in creating disruptive or innovative solutions that have a social impact. This is our mission, and I hope to talk to you later. And let's drive the blockchain adoption together. So, any questions? Yes.
I had a question. Thank you for your presentation. And just on that last slide, you mentioned about the project that you're doing together with Acre and Etherisc. And so in that partnership, can you explain exactly like who does what, among the three players?
So we are. I think Etherisc is basically the backbone. Is providing the development framework. It's a Ethereum blockchain that we're talking about. The parametric insurance use case is pretty similar, or actually is this one. I think, so we are definitely here, the ones that talk with the data providers and enable the data providers to put the data on chain. We are the ones that are basically also monitoring the real-time events and pulling the information over.
Providers are they're all public source data, right? Or no?
The open, you mean the whole use case itself?
For like all the inputs into the third-party data sources. That's
the data, this data?
Yeah.
This data is not always open source. We are using open data, but
in this case even open source. This is standard US government operated satellite, weather data satellite, ARC2. So it's just an FTP server where we download the data and route it through the oracles and then use it in the product.
But there are also other data sources. So, for instance, Van der Sat is a data provider of Acre. So, yeah, not only open data. And then Acre, I think, I don't know, we should ask Benson. I think that distribution is an important fact. Education, the work on the field. Yeah. Product design, exactly. Yes.
question. So where does the data come from? What if there is no data? Where does it come from?
Yeah, so, I mean, it depends on the use case that we are talking about, right? Usually if we're talking about crop or flood or weather data, we have all this data from satellites, right? Satellites are all over the place right now. If we don't have data, but we need data, we need very specific data, we find solutions on the field. You heard, I think, from Benson from Acre, a solution is to take photos on the field, or we just start to generate new data by using IoT sensors. We have to, of course, think what type of data we need in order to assess automatically this real-time events. And I agree with you, in Africa, sometimes we really have the case that we don't have the data. But there are solutions in place, or we are creating solutions.
So Pula collects its own data. So we actually do on-farm yield measurements, and that's how we collect our own data. And so then that is our primary source of the execution for the loss assessments and payout calculations. So when we say, because we also claim to be end-to-end, and so we're doing everything from product design to the payout determinations by also doing the actual in-season harvest measurements.
Mm-hmm.
So we follow the FAO protocols on that, but we keep tweaking that, and then we're also supplementing that with satellite technologies and doing soil moisture, things like that. And then, I mean, you cannot do that for all crops, but you can certainly do that for many crops. So I think right now we have protocols for about 20 crops. Certainly all the cereals, oil seeds, many tubulars. So any crop, like agricultural crops that have a specific plant date and a harvest date, you can do this. It's a little bit trickier when they're perennials, like coffee or cocoa. These are a little bit more tricky to do with a yield index, which is basically what we do. And I think within the space, in terms of the yield-based index, Pula is kind of the private sector leader within that space.
And I think one example to which everyone can relate is AccuWeather. This is one of our partners, satellite data or temperature data from AccuWeather. Any other questions? Yes.
Are you looking into any other solutions for parametric insurances? Because I see the case for using temperature or rainfall, but I think there's lots of more data points that we could use, and also quite innovative data points maybe. So social media for D&O insurance, or I think there's lots to think of.
Absolutely. So yeah, social media is it's a good example. Fake news, all these data points are already in our focus. So one of our data providers is Associated Press in order to develop this kind of use cases. And of course, the spectrum of parametric insurance is very big. Yes, definitely. Oh, but I mean, these are not only the use cases that we are currently supporting. The whole spectrum from hail, from fire, from everything is there. Okay.
Thank you.
Hi, everyone. My name's Ray. This is Jack. And we're here to talk about investing. So I think Christoph and Hugh mentioned Nexus has a capital pool that sits in the middle of the whole thing, backing the covers. And we've been part of a sort of community team that's figuring out ways to earn a return on that capital pool. And we're here today to share our experience of it so far and tell you guys how we think about it. My experience is as an actuary, worked in traditional insurance for a while, but was one of the early employees of Nexus. And I actually stood on the D1Conf stage in 2018 in Prague, talking about, oh, wouldn't it be great if we, you know, when we raised the capital pool, we had some investment assets, maybe we could go and put them somewhere. And here we are now 4 years later with the whole universe of assets and have actually been doing it, which is yay. Cool. So a bit of background about the investment hub and how we set up. So we started in early 2021 to really kind of do this in a more formalized way. And we got 7 members with skill sets across sort of investing in blockchain and DeFi, some traditional insurance senior professionals who work in their investing teams, and prominent members of the Nexus Mutual community like Jack and a few others. And we got a budget approved from the community fund, and because we were all part-time, we allocated it based on contributions, so we all voted on how much everyone's contributed in a given time period and allocated the budget based on that, which is quite interesting. So what role do we play and how does an investment go from A to B in the Nexus world? So we kind of sit at the start of the process. Proposals can come in either from us or from the members themselves, and the reviews happen in the same way. So we will scrutinize it and the members will scrutinize it, but the governance decision ultimately rests in the hands of members. And if that decision is a positive one, which hopefully after going through that it is, then we hand it over to the core team to actually implement it. So that's, you know, the technical side of implementation. In reality, you probably have the core team involved in an early stage because you don't want to really push something through that then turns out you can't implement. But that's kind of the general process. So what have we done to date? So we defined the investment philosophy, which Jack will talk about in a bit, kind of the key points around that. I think we've looked at about 25 opportunities. This is kind of a serious investigation once we're like, okay, this could actually happen. And now we need to go dig in, do the due diligence, read through all the economics of it. And to date, we've made 2 investments in staked Ether, so in the Lido protocol. And we've generated, so those 2 investments in total, just under 30,000 ETH. And we've generated about 1,000 ETH from that. I think it's about a 5% weighted return rate per annum. And we're currently got 2 further investments in the pipeline that are being investigated from a technical perspective. Cool. So I will hand over to Jack to talk about philosophy and assets.
Sure. So I think probably everyone here is comfortable with these are kind of generally the risks that we see when we're kind of looking at different opportunities in crypto. I mean, obviously we all face these. Some of them are a little bit specific to insurance, and a lot of them really only come into effect when you're dealing with huge amounts of capital. So if you're just, you know, putting a couple $1,000 to work in a DeFi protocol, you probably don't need to worry about liquidity too much. For us, you know, if you're looking at putting 20, 30, $50 million into a protocol, liquidity becomes quite a concern. Our experience has generally been that, like, liquidity for a lot of these protocols is very much like the collateral backing Tether, in that it kind of doesn't exist. So the reality is you end up shrinking down your possible asset of sort of universe of assets by like an order of magnitude. Really, the other ones that are kind of specific to us would obviously be regulatory concerns. The most obvious option, would be to just give capital to a hedge fund or a market maker who's doing things off-chain, and they can generate. Some of the ones we've seen are like upwards of 50% returns per year, with like 3+ Sharpe ratio on like very significant amounts of capital. But obviously, regulatory issues kind of prevent that. You could easily imagine a scenario where you give them the capital, and then there's some sort of regulatory change in their domicile, and they can't give the capital back to you. So getting things off-chain, kind of a no-go. So you're sort of limited, in our case, to things that are going to be on-chain. These are really the way that we think about sort of risk bucketing and benchmarking. Generally, we're talking about holding 10 to 20% of capital in cash. That's really because we're kind of just doing cat bond type stuff where you don't need massive amounts of cash on hand to pay out claims at any given point. We kind of defined low risk assets as staked ETH, some sort of E2 staking option. Currently, as Ray said, we're 20% invested there, with the other 80% sitting in cash where we look for opportunities to invest it. And then medium and high risk. For those of you in traditional insurance, you'll probably be like, wow, that's quite a high target allocation for high risk investments. I think what we see so far is that the actual difference between low risk and high risk opportunities is not that big. It's definitely like not comparable to traditional opportunities where you have Siemens bonds, and then on the other end you might have like some sort of equity investment, and it can be quite a different risk profile. For us, the difference between something low and high risk might be relatively minute, and might be in terms of liquidity rather than the underlying asset itself. So one thing we kind of focused on heavily is ETH2 staking, and that's just because right now, nearly 100% of the assets for the mutual are ETH or staked ETH. One of the big pros really is allowing the mutual to remain long ETH. Ultimately, the mutual runs based on what the members want. The members want to stay long ETH because people generally have, people are generally bullish ETH in this space. So while we might have liabilities that shift more towards stable coins, we're lucky that right now we're quite heavily overcapitalized, and so we can afford to have a little bit of an asset liability mismatch there and remain long ETH. On the con side, I think really the big things that we think about are what is the risk specific to the different node operators. That might be geographic, that might be what kind of guidelines and rules do they have to follow in order to like recover from events and downtime. And I kind of touched a little bit earlier on centralized managers. This is really probably the best risk return that I think people can get in the crypto space right now. But we're kind of off limits to this just because liquidity is essentially zero. You end up doing quarterly or annual redemptions. That doesn't really work when at any point you might need the capital to pay out claims. Obviously, you have low to no protocol risk, especially if people are doing market making. At that point, really, the main risk you're taking on is the counterparty risk and obviously the risk of the exchange itself. In this case, like if it's a Kraken or a Coinbase, it's relatively minor compared to what you might see when you're looking at DeFi protocols. Another benefit is obviously having some sort of guarantee in form of legal agreements. It's always nice to be able to sue people if you want your money back. And I think Ray's going to talk a little bit about the DeFi protocols.
Yeah, so this is another area that we're actively investigating, and probably the greatest variety here in terms of what you could invest in. So, a sort of Uniswap automated market maker being a liquidity provider for that is very different compared to putting it in, even in Aave or Compound, never mind all the hundreds of different things built on top of those. Here, I think we like that, these are also protocols trying to build a permissionless finance system, and we very much like fitting into that system of money Legos. And also the technical implementation, while not easy, is possible. These are people speaking the same language, and the devs speak the same language. And often the liquidity is quite high compared to, I think Jack mentioned that with kind of centralized providers, it's harder to do that, but here we can buy and sell whenever we want to. On the downsides, it's very easy for us to run into concentration risk issues, so that kind of goes both because we're protecting these protocols, but also putting a portion of our capital in those protocols, and that's not a very good thing. Then if one breaks, then all of a sudden we left with very little. Protocol risk of the kind that I think Peter talked about was very, and that we also cover is very high here. The returns can be very variable, and I guess linked to the next point is that it requires active management. So often a new yield farm will come out, not that we particularly tend to go for those because of the risk profile, but a yield farm will come out and offer you 100% returns for 2 weeks, but then go to almost nothing a week later, and we see quite a lot of that in this space. Those kind of the three broad categories of things that we think about. I guess just to finish off on some lessons from our experience, so hopefully if someone is thinking of deploying their crypto in an institutional sort of way, what is there to think about? Well, surprised to know when the space moves very quickly and you have to keep your eyes peeled for opportunities all the time. Have to be very thorough. I guess, in traditional finance, maybe one bond is not that different from another, whereas here every protocol has its own idiosyncrasies, and same goes with the teams underlying those protocols. It's not a standalone activity. You had to really get the tech team involved early to identify any issues and any other teams that might be relevant to this. Integrating with other protocols is a lot of work, and dev resource is probably the most constrained thing in Ethereum right now. And I guess the conclusion is it's a hard problem, it's a unique problem. There's liquidity issues, technical issues, concentration issues, diligence issues, and tax issues, and compliance issues. But it is doable, and it's certainly important, to be able to do this in a proper way. So yeah, I think, from a Nexus community perspective, open call to get involved for those who want to, and think that if you have good ideas, then we're happy to hear them on the forum and in the Discord, etc. I guess, yeah. So thank you. This is a very brief fly-through. We couldn't go into a lot of detail because of the sort of time constraints and people want to break, but very happy to talk to anyone after the presentation and take a few questions now as well. Thank you. Yes, Christoph.
How transparent are you over the process? So the process of selecting and discussing, evaluating, is it something that what happens under the eyes of your public community, or is it in a closed shop? And if it's public, could there be a specific risk in doing this in public?
So for the DeFi stuff and for the staked Ether, we tend to, one of the members will draft a proposal and it will go on the forum to be debated straight away. With some of the centralized providers, they are not open to that sort of thing, so we are not quite as fully see-through, but ultimately anything that we approve has to go to member governance, so it has to be open before it gets implemented in some way.
Yeah, I guess one of the most obvious problems with that is you can just get front-run on things pretty hard. And if you're putting a very significant amount of capital into something that's kind of liquid, that obviously becomes a problem. I mean, or anyone who's followed the buyback process that we've gone through, you just get front-run.
Yeah.
but that's kind of the trade-off with DeFi in general, right? And anything that's decentralized, you know, you always trade off that transparency. You know, you get traded off for people front running you.
How diversified are your DeFi positions? Like how much, like what assets do you invest, like on the spectrum?
So currently, I think we have about 80% in ETH and 20% in staked ETH. So not very diversified at the moment. Yes, very interesting protocol. I guess the liquidity is still a bit low. I think we find it's quite uncomfortable for us to be a huge portion of the underlying asset.
Yeah.
But yeah, I think we're looking at all the staking providers and monitoring them very closely.
Yeah, I think last time I looked, Rocket Pool's like 1% of the size of Lido, and we're like the third biggest staker in Lido. So already that liquidity on Lido becomes like a little bit uncomfortable in terms of like, you know, post-merge wanting to actually get out. That's going to be tough. Slippage probably pretty serious there. I mean, we are looking at Rocket Pool pretty openly. I mean, we discussed it on the forum, I think. I think one of the big blockers right now is like they don't have a Chainlink oracle. So getting like an accurate data feed for what the actual price is, that's quite important. So Chainlink, we've talked to them about getting it set up. My understanding is like Rocket Pool don't have enough pools with enough volume per day. So there's not like a good data feed or something. Once that's solved, Rocket Pool is like obviously a pretty obvious place to stake.
Yeah, I guess that oracle problem goes more widely as well, because a lot of the DeFi stuff that we look at, we need that instant feed to know exactly how much money there is in the pool, so that you can back covers accurately. And if there isn't a reliable oracle that gets updated in real time, then it doesn't quite work for us. Yeah, at the back.
Thank you. Great. Thank you. Very interesting talk. All the risks you classified were like inter-ecosystem risks. So all your risks are inside the Ethereum ecosystem, in the wider Ethereum ecosystem. But when you price risks, you also price like international exchange rate risks or stuff like this. So do you also have some kind of mechanism to price like what you do in the Ether space versus what happens in the fiat space or with other currencies, cryptocurrencies?
Yeah, I don't think all of them are exclusive to just the Ethereum ecosystem. So for example, illiquidity is very much a centralized issue to get it to us. Counterparty risk, I think we had on the list there, which is very comparable to kind of traditional counterparty, yeah.
In your talk, you were always looking at, okay, this DeFi protocol has this problem, but you never like talked about like, okay, what happens if Ether versus the dollar slips and you can't get out in fiat for business expenses and stuff like this. So you were only looking at one ecosystem you're part of, but not the other outside ecosystems like fiat.
Yes, so there is, this is slightly separate from the community fund and from the foundation, which kind of deals a lot with the real world. There is certainly an ALM piece for us to have a look at, but I think Jack mentioned our members really enjoy being long ETH, so we focus on that at the moment. But yeah, that's definitely in the works to create a closer asset liability match. Okay. Well, thank you very much, everyone. Appreciate it.
Thank you.
Hello.
So welcome back, everyone. We've made it to the third block about massive adoption. And we're going to hear the first presentation from Arturs Kokins from CAFCO about safeguarding crypto assets. Arturs, the floor is yours.
Hi, that's great. I'll just quickly put a presentation on my screen. Right, I hope you can see this. Sorry, just checking, is my presentation visible? Yeah? Oh, that's great. Thanks. Right, so yeah, really nice to be here. And so my name is Arturs Kokins. I'm a managing principal at CAFCO. And so CAFCO is a management consultancy, and we work a lot in the financial services. So we do a lot of work with insurance companies. And I myself have spent the last 10 years or so working with insurers, reinsurers, brokers, on many different things, but increasingly so on, advising them on how to think about insuring intangible assets. And so obviously crypto is a big part of that. And so that's really what I'm going to talk about today. So, what are the opportunities in this space? What are some of the challenges that I see? And I'll maybe start with just a quick hypothesis that, I think that crypto assets are here to stay. They will grow, and, they will become the new normal. I'm sure many of you in the room will agree with this statement, but, if you don't, then I'm afraid you might find the rest of my presentation a bit irrelevant. So, if there's anything better for you to do. But yeah, so that is the hypothesis. I think there are many signs of that, right? You have the technology spreading, you see more and more use cases, you see wallets growing, and I think they'll keep growing. And as that happens, that will obviously open doors for a range of digital assets. You have things like custody of digital products becoming, a standard offering in the capital market. And obviously tokenization allows more efficient financial products. But so if you believe that this hypothesis is true, I think you will quickly realize that, the future is really bright for the industry. There will be many, many different use cases and, tremendous opportunities for crypto insurance. Now, obviously people are dreaming about all sorts of stuff in this space. But one of the interesting recent examples that I found curious was just an announcement by HSBC saying that they are buying a plot of virtual real estate in an online gaming space. They also said that they're launching a metaverse portfolio for their clients. And if you think about this and how all of this could develop and evolve, you can immediately start thinking about things like, well, what would those, virtual properties mean for things like virtual mortgages, virtual property insurance, virtual credit default swaps, and many other things. And so immediately people will be thinking about all of this good stuff. And obviously it's a nice dream, right? But at the same time, I think that it's fair to admit that crypto asset space is still not mainstream. And there are, many signs of that. But I think sometimes a really good demonstration of something like that is just looking at, mainstream media and what's being said. And so I'm sure many of you are familiar with the recent Ronin network hack. So long story short, some $650 million value was stolen. The interesting thing about that was that there was barely any interest from the mainstream media, at least initially. There's obviously lots of chatter in various crypto communities, but that's about it. And if you think about it, if you think about, for instance, an individual or a group of individuals entering, I don't know, a major bank in Amsterdam or London or New York or anywhere else, and, stealing $650 million of traditional assets, I am sure we would see an entirely different reaction from the mainstream media. So I think perception matters, and I think that people's perception about the value of and importance of crypto assets is still very, very different from the perception about traditional assets. And so, so how do we move that to mainstream? And obviously, many of you in the room are working on various things, right? But I think one of the interesting aspects here in my mind is that we need to make the whole thing more boring. It sounds weird, but I think if you ask a lot of very traditional financial services players, I think they'll tell you that the whole space just feels a bit too exciting, too volatile, too uncertain, too weird in some cases. And what they want is, something more stable, more dependable, more predictable. And it certainly applies to traditional insurance. And so, the various developments more recently around, central banks experimenting around, the kind of centralized stable coins and some of the regulatory developments, I think it's all good news, really, to make this space a bit more boring. And I seriously think that the more boring it becomes, almost the better for the future of the insurance industry. Now, it is important for the insurance industry because if you think about how the industry is structured and how it has operated in the past, you'll see that it's all concentrated around traditional assets. So that is what the insurance businesses are used to insure, right? So property, machinery, all sorts of equipment, things like that. And the interesting thing is that if you think about the value around us, I don't know, take S&P 500 market value, for instance, you would find that an increasing proportion of this value is intangible. So things like reputation or intellectual property are suddenly really important. And insurance companies are really, really struggling to insure intangible assets. Again, many reasons for that. I already mentioned the point about the space becoming more boring as a good thing. But yeah, I think a lot of players are struggling to quantify these things. They're struggling to predict what's going to happen. They have limited data points from the past. So it will take a while. I remember speaking with someone from Google a while ago, and we talked about insurance and some of the developments, and the point made there was that and insurers talked about understanding cyber risk, and insurers talked about cyber as an emerging new risk, and the point that companies like Google would be making, well, cyber risk it's not emerging. Obviously, it's been around for decades now, basically, whilst insurers are thinking about that as something new. And so crypto is no different, right? Crypto is part of this puzzle. And the point is that you suddenly have this new ecosystem with a large number of new risks that are hitting all these different ecosystem players. And obviously, insurers are struggling with that. I think according to some estimates, only around 1% of that value is currently insured. Obviously, the total value is in, many, many billions of dollars. So that is the value that is currently unprotected. And that is, in theory, a fantastic opportunity for insurance players. The good news is that the market is picking up, and you can see a lot of activity around different things. So starting from direct-to-consumer insurance offerings. So that's really about individuals protecting their wallets against hacks and things like that. Then there is more traditional commercial insurance offerings where, and that would mostly be around transaction facilitators who would want to have some coverage. That is the space where some of the more traditional insurance players have started getting involved recently. You have some experimentation around embedded insurance. Coinbase is a good example where they're providing some protection in case of a platform-wide cybersecurity breach. And then there are some relatively niche specialized insurance products. Crypto mining is one example where obviously you have very, very specific, quite unique risks and clearly you need coverage. But I think the interesting thing again here is that most of these efforts are coming from insurtech, so new startups. The incumbents, the big incumbents who have a lot of capital, right, are still playing this wait and see game a little bit. They're trying to understand where it's going. They're sometimes backing some of these startups. But I think for this to really kick off, you obviously need to see way more activity from big established insurers and reinsurers. On that point, on this page here, you can see a graph that shows the combined ratios of Lloyd's syndicates over the past 10 years. And for those of you not really close to this, I mean, the insurance market is really cyclical. So you have some years where the market rates are pretty high. Not a lot of capital is available. And so the insurance players who are operating there are able to generate pretty good profit margins. And then normally what happens is that as market continues being attractive, you start seeing more and more influx of new capital. Therefore, prices start reducing, and then therefore, profit margins get tighter. And then eventually you get to a situation where some of the losses start accumulating, profit margins are tight, and therefore, some players get into trouble, start exiting the market, and kind of the market flips back again to higher rates and higher profit margins. Now, so combined ratio, 100 plus is basically bad because you're losing money, and below 100 means that you're making money. And so you can see here how right now, 2021 is looking really, really good. People are making money. So Lloyd's market is obviously the center of specialty insurance in the world. So those are exactly the players that you would expect, should be the first movers in things like crypto insurance. I would make an argument that this is the best time possible for people to enter this space and, go and experiment, go and learn. Yes, maybe make some losses, but actually without really troubling your bottom line too much if you, put the right limits in place. So it's a great time. The interesting thing and the biggest challenge is that I think a lot of executives also think that this is exactly the right time to, generate a lot of money in traditional products. And so, why should you go to this super exciting, super volatile space if there is the good old traditional, property insurance market and casualty insurance market, which you have explored for decades you know how it works, and you can generate very, very good returns because, you know, rates are high. So I think that mindset will need to change. I've seen that changing in some pockets, but obviously it needs to keep evolving in the next few years, and hopefully we'll see more products in the space very, very soon. Meanwhile, just another thing to note, I will not dwell on this too much. Obviously, you heard earlier today some really good presentations from Nexus and from Etherisc. And there are a few more presentations I know coming up after mine. But you know, while some insurers are thinking about all these coverage gaps and coming up with new products, you have these really, really interesting developments that have started emerging around challenging the entire insurance model. So it's kind of looking at the traditional insurance business model and thinking about ways how you can decentralize some of that and make it more efficient, make it more fair, and so on. And so it's really great to see. Again, my worry is that, you know, most of the developments are coming from new players. I mean, it's great, but I would like to see more developments from big incumbents in this arena. The good thing is that as more and more projects come along, I think the well-established insurance companies are learning from that, and you know, hopefully we'll see more and more support again from their executive teams in terms of embracing some of these emerging models. So to wrap this up, really, I think there are three things really that insurance companies need to be thinking about. So one is, how do I start experimenting with coverage for crypto assets? So as I said, you know, it's billions worth of crypto value sitting unprotected at the moment, and it's a massive opportunity for insurance. Secondly, how can I embrace and operationalize a decentralized insurance model? And as I said, it's great that some of the startups are experimenting with this. I want to see more activity from incumbents. I think it's, again, a great opportunity. And then finally, you know, how can I make sure I'm attuned to market developments and regulatory changes? You know, obviously this community here in the room is kind of self-selected, right? You're all interested in the space and you're all really knowledgeable. Many of the execs, I think, in the insurance space are still getting up to speed, right? And still trying to understand what cryptocurrencies are and what crypto assets are and how it all works. So there's a long way to go. I think that education needs to continue. But, you know, with every event like this and with more and more activities, it's getting better and better. So we at Capco are advising insurance companies on all of these three questions, and we are working through that, kind of trying to help them figure out where to go, figure out how to implement some of this new technology. So, you know, reach out to me if you want to learn more, and happy to take any questions if there are any in the audience right now. But yeah, that's it from me today. Thanks a lot.
Thank you.
Thank you, Arturs. So, next up is... So next up is our friend Martin Bayer from InsurBlocks, and he will talk to us about use cases for parametric decentralized insurance. Martin, the floor is yours.
Hi everybody, I'm Martin, co-founder of InsurBlocks. It's great to be back again at D1Conf. I've been there in 2018, a bit more audience and not so quiet as it is here today, but it's great to be back and to listen to the projects and the progress that some of you have made, especially, of course, Etherisc and Nexus Mutual, but also many other projects, some of them new. I would like to talk to you about InsurBlocks, my startup, and the path that we have in front of us, our plans and our use cases. I have been working in the insurance industry for 15 years, and when I heard this sentence from Sergei Nazarov from Chainlink, I had a big smile in my face. He basically says that he's expecting that all financial products are one day going to be on a smart contract, including insurance processes. And with all his brevity, he says this is totally inevitable. The only question is when this is going to happen. And of course, that's an issue for all the startups and also the more experienced startups like Etherisc. Yeah, how early are we in this industry with adopting blockchain? Our mission at InsurBlocks is also to blockchain insurance. And when we say this, we think of real-world objects, as they were mentioned here already before. We have some traction in all the 4 fields that you can see here. So agricultural insurance, maritime and logistics industry, weather insurance for private people, like people going on a holiday, and also the energy market. These are kind of the 4 areas where we have been active so far. So we are looking at physical risks, parametric risks in a specialty, and we're looking at insuring real-world things. We have 3 major building blocks that are important for our strategy and our vision. The first one is parametric coverages, as you might have expected. The second one is the peer-to-peer model, where I especially like the concept of mutual insurance, where risks are shared and where we can overcome all these issues with traditional insurance, with intransparency, with that insurance is not reliable, you can't rely on the payouts, and that, of course, that it's quite difficult to deal with them. And the third one is embedded insurance, so insurance that is not a standalone project, not a standalone product that you buy, which covers you against all kind of risk types, but insurance that is more embedded into other industries and is part of the core offering of other industries. It's not just seamless integration of insurance into front ends and platforms. I think here of more than that. This is the team that InsurBlocks at the moment has. There are 2 co-founders. I've been working in the insurance industry for 15 years, working for major consultancy companies and also for major carriers in different topic areas. My co-founder Christian sits at the back in the red polo shirt. He's our energy specialist. He worked for several years in the energy industry. That's kind of the sweet spot nucleus that we had when we founded InsurBlocks. He has also long-range experience in different board positions, also in the e-commerce industry. We have a team of developers that we have worked together with so far and that we can rely on for the future. At the bottom right, you can see the team for our last prototype that we worked on during the Chainlink hackathon end of last year. And there's one guy from the team in the room, Kevin, here in the third row from Paris. It was, of course, an international team that gathered for this exercise. And we are continually learning through these exercises. And this is our roadmap. I personally came in touch with blockchain in 2017. That's when I also met Christoph and Hugh Karp. Some of them had some other use case in mind at the time, especially Hugh Karp was on a different track at that time. Interesting to see how quickly he was successful by pivoting the idea. So in 2017, I was an employee of Zurich Insurance Group, and we developed a crop micro insurance scheme, as I think this is still the greatest use case that we have seen so far. Maybe a bit difficult for a small European-based startup to tackle with. Yeah, Ocean Storm, I'll talk about that on the next slide, is a coverage for the maritime industry, also a parametric coverage. And what we are looking at now is the travel industry. So we want to insure holidaymakers against bad weather events. We have done some customer research here. It's fairly manageable exercise that we are going to look at in more detail now. We are currently in an accelerator program and are also preparing the incorporation. And for the medium term, we are looking at these embedded insurance options with a special focus on the energy sector. We are already doing user research here as well, especially on the customer, on the commercial client side. Yeah, what have we done so far? Regarding the parametric insurance, I can briefly touch upon our ocean storm coverage, where we use the standard technology stack that you would expect. So we are insuring ships, vessels that are on the ocean against hurricane events or strong storms. And we use the Chainlink technology for that and some public APIs to track the vessels and to track the weather situation on the track of the ship. And we want to leverage, of course, this experience from here to other use cases in the travel industry especially. Yeah, regarding peer-to-peer insurance, we discussed that already quite extensively today. There are some prototypes around already with Nexus Mutual and Etherisc. I used some of your nice graphics for this slide. So maybe that is also a platform for us. We will of course look in more detail into the options that it brings for us, the flexibility, etc. Thanks for being able to present here, and of course we will stay in contact and discuss the options. There are of course major issues attached to that. The first one is regulation. Yeah, if you want to sell to German customers a product called insurance, you're facing some issues there currently. So we have to check if the UK option and this discretionary coverage is a model that we can use more easily. And still there is the issue of pricing expertise. How do you integrate that? Do you do that off-chain? Do you use experts that get incentives for providing the service? So all kind of these questions that we have to look at. Of course, we are striving to replace existing insurers and want to make use of this model. Yeah, regarding embedded insurance and our focus on the energy industry, I want to briefly highlight our reasoning behind that. So if you think about the energy market, it's expected that the amount of energy produced is going to triple by 2050. Something I think not imaginable as of now. Yeah, we're facing all these climate change issues and have to radically change our energy system. At the same time, it's expected that we that the energy demand will increase substantially in the next years. Some people say that the energy question is solved with solar energy facilities that can vary. If solar plants, photovoltaic plants are installed in Saudi Arabia, the costs are already very low, so maybe it's more a political thing to organize it. But still, it will be a tremendous revolution that's going on here. We will see millions of households that engage in this field, that produce energy, that also store energy in smaller facilities. We have electric vehicles, which might play an important role in stabilizing the electricity grids. So you think of this, there are millions of devices in that field, which then will change the way people interact. Yeah? We will see peer-to-peer platforms for trading energy on a local basis or on a wider basis. And another thing is machine-to-machine transactions. If you think of drones and other battery-driven equipment that wants to reload itself, then we will see more and more machine-to-machine transactions. What we also see is that distributed ledger technologies play a more important role already also in the energy field. We've seen tokenization project, for example. One of them is from Riddle & Code in Vienna, where big photovoltaic facility is tokenized, and the consumers of the energy also pay with the tokens. So probably we will see more tokenization project in this field. Also, data is an important thing. To check the origin of renewable energy and also to prove the CO2 footprint. So if you see this industry in a rapid change and you're looking at it from an insurance perspective, you might think that insurance will dramatically change. You don't need a one-year contract that protects you from all kind of risks. Insurance will be more a layer integrated into this sector, just like the payment layer. Yeah, that's been my brief introduction into our plans. We made some progress already with some prototypes, and we are now diving deeper into the travel segment. We want to grow our team, of course, throughout the next month. So happy for any ideas for great people that would be interested. And now, of course, I'm happy to take your questions. Thanks for your thanks for being here and listening. Thank you. Looks quite silent. Yeah?
I have a question regarding embedded insurance. It seems like, that model involves new type of business creation involving the traditional player, like operators such as an energy company. And what do you see as key success factor for that area, for your business to expand?
Yeah. So the question was about embedded insurance. I'll repeat that for the online audience. What are the key success factors if you want to go into embedded insurance? Yeah, the main one is data, of course. Yeah, if you follow my definition, embedded being really ingrained into the core value proposition of the other industry. Then it's about the data that you get. We see that Google and Amazon invest large amounts into the data field in the energy industry. So they want to really make profits by dealing with energy data. And if you have all these kind of IoT data available, you can build new insurance offerings on top of that. So it's then, of course, being able to deal with the hardware and to understand how to mix the data. Actuarial models will be built around these data, and then, of course, at the end, you will need a good insurance process layer to deal with it. Yeah, no more questions? Then thank you.
Maximilian Sourisseau, yes, who will talk to us about Blocksurance, an Ethereum-based community fund. Maximilian?
Thank you very much. Just a quick word before. If you don't understand all the words on this slide, don't worry. I will explain what all of that means, including the word tontine. But I'm hoping Ethereum and peer-to-peer you already knew. But the rest I will get into. First, let me start with who am I? I'm a consultant at HBA Consulting, and I also do business development for our Blocksurance brand. I hold an MBA from the Asian Institute of Technology, as well as a BA in business psychology, so I'm probably one of the few people in the room without a formal technical background. My road into the crypto and blockchain started in 2013 when I very unsuccessfully tried to mine Bitcoin on a laptop because I had free electricity in my student dorm. And I got heavily involved in blockchain cryptocurrency in 2017 with my decision at the end of 2017 that this is the space I want to work in full time. And I joined HBA Consulting in 2018. So, who's HBA Consulting? We are an 18-year-old boutique management consulting company who consults mainly German life insurance companies and pension funds and other specialized players in the German insurance market. Our projects include actuary consulting as well as IT data migration. There probably isn't one big IT data migration the German insurance markets we haven't been a part of in the last 18 years. So we're very much combining the knowledge about technical systems inside of insurance companies with a deep knowledge of how insurance products, how insurance companies work. So the first word on my title is Blocksurance.
what is blocksurance? Quoting my CEO here, blocksurance represents the idea of combining insurance expertise with blockchain technology. So what we really wanted to do, not coming from the tech startup side, because we're not a technology company, we're a consultancy, and we're not a startup. We're 18 years old and have 50 employees and revenue of, I don't know, 8 million or something. So we really wanted to take this in-depth knowledge about insurance companies we have, because if you do data migration, like every piece of data this company has, you touch. So we have a really deep understanding of insurance companies, and we combine that with our technical knowledge we built up of the blockchain technology. And then, and I promise, this is the last of like marketing slides. After that, it gets a bit more interactive. We asked ourselves, okay, with this concept of blocksurance, what could we build? And then the answer was, yeah, a collaborative insurance product. That sounds good because DLT or blockchain allows us to build collaborative products. So we thought about a community fund, that's what we call it, as a fully automated open pension tontine. Again, all the words, especially the word tontine, I will explain, don't worry. For those coming more from the insurance side, probably the phrase shifting the longevity risk to the collective makes sense. For all the other people, I'm getting to that. And yeah, then we choose the Ethereum network because it gives us the ability to do fully automated stuff, fully transparent stuff. And our sales point was that every user can audit the insurance contract, something you probably can't even do, even if your insurance company sends you all the documents and all the things, because it's pretty intransparent. So we saw an opportunity to provide a completely new type of product. Even after having heard all the products today, we still believe we do have something a bit new because it's a pension insurance and it's not parametrical. So I think maybe it's something actually really new. So again, that was more or less the last marketing slide. But question to the audience, have you heard of a tontine before? 1, 2, oh wow, okay. You could have heard it from this series, and if you know that, that's MASH, where they have a famous episode where, like, if the last group of friends has only one survivor, they get the bottle of whiskey. You could have heard it from The Simpsons, where they have a similar concept where Mr. Burns tries to kill the grandfather, I think, because they both also in a military platoon paid into it. Maybe now a few more people remember it. Or you could have known it from a paper called The Simple Analytics of a Pooled Annuity Fund. If you've known it from that source, we should talk after, I might have a job for you. Okay, but let's go down to layman terms. What is a tontine? It's a collective fund with a shared goal and desired longevity. So a group comes together, shares some funds, agree on a goal, and believe, okay, this is not a one-off thing. We're not pooling our resources to get a drink. No, we're doing something that has a large time horizon. That's it in layman terms. No need to understand complex insurance products. That's it in layman terms. Typically, when they pay into the share pool, at this point, they agree on a set of rules they set themselves. And historically, there were 3 flavors that existed of that. The first flavor was the investment tontine. So we have a specific project in mind. Historically speaking, often it was a dam or a canal, especially here in the Netherlands. Many of the canals were paid for by tontines or a war effort. Usually how it works then, okay, you collect the payments from everybody, and as long as the holder of that investment is still alive and the project is still generating funds, you pay the return on invest out to all the people who paid into the canal tontine. Then the life insurance tontine existed, which is based on a payment upon death for the relatives of the holder of the tontine. And usually, due to the long time those tontines run, they have a lot of accrued interest, and tontines always finish their money. They always end when they fall to 0. So if it's a life insurance tontine, it can get to the fact that the last person gets quite a lot because there is still a lot left over in the tontine that hasn't been claimed or so it falls to the last person, which explains why in The Simpsons they constructed this conflict about, oh, I have the moral hazard, if I kill you now, I get a pension payout. And the third one is the pension tontine, which we're going to talk about today a bit, because we built one, where we have an ongoing payment, so you get a monthly or yearly pension, which is based on the remaining capital stock that the tontine holds, and who is still alive, so who is still receiving payments from it. Okay, now you think, wait, like my private pension insurance or even my government pension insurance does the same thing, gives me monthly payments. Yeah, it's a bit different, because if you have a private pension product, I'm using the example of private here because governmental pension insurance in Germany works very differently, and to be honest, I know the most about the German insurance market and not so much about the Dutch where we are here. So in a private pension product, you have a guaranteed minimum. So you have agreed upon with the insurance company, you get, I don't know, 150 euros, 1,500 euros every month. And then if the investments that your insurance company made or the cost savings they made with a new technology are great enough, they add that on top. But you have that guaranteed amount. No matter what happens, you will always get that. In a pension tontine, you do not have that. There is no guarantee because it can only work with the money that it contains. So if the interest rate is high, and maybe a few people died early, your pension might increase, might get more. Or if the interest rate was low and more people are living than your mathematical model calculated in the beginning, your pension amount might decrease because there is no insurance company in the background that has to put money in for the guarantee. Because that's what we see with the private pension products often. Like the interest rate the insurance company gets at the market is lower what they need to guarantee, so they have to substitute that. That's actually creating quite a big loss for some insurance companies. Also, there are differences in the investment strategy. An insurance company has to have a quite careful investment policy, as they have to always meet those guarantees, because otherwise they have to substitute. Also, there's regulatory. And in a pension tontine, if we agree on a set of super aggressive risk-taking, we're free to do that. We are the only ones suffering the consequences for that. Which means the risk management for the insurance company or the private pension product is rather complex, where in the pension tontine, not so much. And now, to be honest, the market situation is that guaranteed pensions are incredibly popular in Germany, and the pension tontine, to put it nicely, internationally, they're widely available. But now, let us start one. Like, why not? From all we just heard now, we just need a group of people that pay some money into a fund and agree on some rules. So we can build one. And now I'm actually going to walk you through that and always then put in, okay, which criteria did we choose with our product, but we can build one together. Let's build the D1Conf community fund. Let's agree on the rules, everybody chips in 10 euros, and we're not looking about death, but conference attendance, so everybody who comes to the next conference gets a share of the profits we made during the two conferences, and then we buy drinks from it or something. That would be a tontine. We could build that. So what technically do we need to build that, to build our own D1Conf tontine? Okay, first of all, we need a bit of math, because obviously, if we have a complex thing like a pension where probabilities of death, of sickness come into play, you need an actuary, you need math. We have now written 2 academic works on how a tontine could work, given our circumstances. So my colleagues gave me quite a lot on this. Don't worry, I understand it's for 4:30 in the afternoon. I brought you one slide with maths to explain it. I hope that buys me some goodwill. Okay, what else do we need? Obviously, this is an Ethereum-based conference, so we are going to put those rules in a smart contract. So we would need a smart contract that tracks, okay, who attended this year, who attends next year. What also do we need? We need passage of time, because obviously it's a term-based product, it's a longevity product. So either we need to wait till the next conference or the next month till the pension gets paid out. In our product, we need proof of life. So you have to prove that you're alive to receive a pension. That's probably someone like every one of you knows this, that at a certain age you have to prove you're still alive in order to receive benefits. In our conference, Tontine, you just need the ticket for the next conference or something like that. And obviously we want some kind of front end, because like reading raw chain data, yeah, nobody really wants to do that, let's be honest. And wouldn't it be nice if we can take a vote on how the money is invested in the meantime? That is optional, we can just have lying around, but maybe we want to do this community thing here. So yeah, now we need seven things. Six things. Okay, so what have we done? We calculate the first pension by just taking the investment that is in the tontine and divide it by your personal amount you're getting. This AX can be calculated in many ways depending on the rules you set. Easiest rule would be if everybody pays in the same, they have the same share. And then in the next year, okay, we maybe need to adjust it, because in the first year it's pretty easy. Everybody is alive, everybody gets their pension. But then, okay, we have to do a bit of math. Again, this is one slide. We have to adjust for the actual mortality, because in the next year or the next 10 years in a pension, we have to really look, okay, who is still alive, reading who is still eligible for a pension. And then we have to adjust that. When we normally calculate a pension product, you use those big tables, like what is the probability of someone being alive at the age of 78. In a tontine, then, we now adjust for the actual real number, not the calculated number. And of course, we should adjust the pension on an interest rate that we earned in the meantime. Sadly, this can be lower than 1. So this would, with these two formulas, we have our pension at the start and our pension the next year. For our community fund, the math probably can be a bit easier. Maybe we get in a factor of like, okay, of the number of conferences you attended, you get a bonus or something. But some math we need. Then we need to put that into a smart contract. Again, we did it with a few smart contracts. I have not the technical training to explain to you people what it lives where and which bits of code live where, but I'm sure you get the drift. We have a main controller, we have the calculations, the collective, and the insurance contract, and they all share a storage. Basic IT architecture. If you have questions about the code, we can talk later, but just to show you, it is rather simple, we can build that. And I'm sure for the D1 conference tontine, sure there are enough people in the audience who can write up some code for that. What do we need next? We obviously need passage of time. This is particularly easy. We just wait. Yeah. Nothing here. It's just waiting. And now, 1 year has passed, and you all want to receive your pension, or in our example, your drink voucher. If it's a pension, you usually have to submit some kind of life certificate or Lebensnachweis, as it's called in the German Beamtendeutsch. Can be done in numerous ways. This is how the Bank of India does it. This is how the city of Munich does it. Someone with authority stamps a piece of paper. How will we do it? Probably with a signature of a private key, I would assume. Okay, I said, what else do we need? Front end. Okay, I don't know how the one for the conference one would look like, but I can tell you how ours looks like, because all what I was explaining now, we actually built that. It's not a theoretical thing, we're actually finished with that. So we have your data of the insured person, you have your overview of your contract, you see how many people have paid in. Right now our tontine has 7 people and totaling around about 7 Ethereum. And if you want to pay in new, you have to tell us when you are born and how much Ether you would like to invest. And lastly, we said, okay, maybe we want to have some kind of voting mechanism. Pretty like the most basic one, you have 4 cryptocurrencies to choose from, and your vote is based on the share of the money in the tontine that you paid in. And then you click on vote, and then you have voted with an Ethereum transaction. And this is how, in very layman terms, a tontine works and how it can be built on Ethereum, because you only need those few things. Happy to take questions about that. Yes, in the back, please.
I was wondering what's the difference between this and a DAO?
Well, this is an insurance product that is recognized as an insurance product. But obviously, if we use the term DAO broadly, the collective that comes together and makes the decision about the rules can be classified as a DAO. But this could also be deployed by an insurance company who sets the rules monolithically. So this can be set up as a DAO, I would argue. But my clients are insurance companies, so you see my kind of conflict of interest here. Yes, please.
Yes, thanks. I have more or less the same question, but not as a DAO, but isn't it probably also equivalent to a decentralized investment structure? Or to put the question in another way, you were talking about the interest rate, yeah? As of course, otherwise it wouldn't make much sense. Before you said for the insurance companies, it's a difficult times because there's, let's say, more or less negative interest rate. Yep. So to make it, let's say, a mass adoption product, would you say it is, because if you just invest into cryptocurrencies, you've got the volatility of the markets. Absolutely. But maybe you would also address like staking investments or let's say other return enhancing elements.
Okay, great question. Let me start with the end of your question about the interest rate and the investing. The simplest investment strategy would be we just go long on Ethereum and do nothing with the money and just leave it sitting in the smart contract. The most complicated version would be we get via DAO, we appoint an active management team that can buy on and off chain things. That would be the most complex. The reality will probably somewhere in the middle. We just heard how Nexus Mutual uses their money and moves it around. Why not ask some people like those if they offer third-party fund administration? So we say, okay, our Tontine, the rules we agreed on is that our funds are managed by Nexus Mutual. That will work. I mean, many smaller German insurance companies actually don't manage their assets themselves, but rather get providers for that. So our Tontine could do that. Or we do it like the rather DAO way. The members of the Tontine can vote in which, if they want to invest with ARV, with Lend, with DeFi, staking, whatever. All of that is possible, I believe. In the end, you always have to keep in mind, you don't want to make it so complicated that every member has to vote like 3 times a month. You want to keep regulatory in mind. But I'm sure there can be a solution found. I think there can actually be more than one solution found, because if I'm the type of investor who wants, like, leave me alone for 20 years, there will be a product for you. And if you're the person who says like, oh no, I want to go do monthly community voting on investments, we can also build a product for you, I believe. With your question, what's the difference between an investment product and an insurance product? Well, that's a bit of a religious question, to be honest, because this harsh legal separation between capital markets and insurance markets, it's a German thing. I come from a German-based company with German-based clients. There we have this very strict separation. In the US, you find stuff like annuity pools that are used for both active investment as well as pensions, because they do not have this harsh separation. We have based it on an insurance product because A, the Tontine is originally suggested as a pension plan. This is the branch we know about, and the Tontine is legal in Germany as part of a company's pension plan, BAV. It has been like not legalized, but it has been expanded, the Betriebsrentenstärkungsgesetz. So now there it could be implemented. Now there we see an actual regulatory opportunity for this kind of product. So this is why we built it from an insurance perspective. I'm sure someone could build it and brand it as investment. Sure about that. Yes, please.
How would you implement proof of life on chain?
Well, the easiest one would be you get like some kind of authority that everyone in the original rules agrees on, and they set you alive. This is what current insurance companies do. They tell you you can go to your local government office or your embassy or your church or something, and if they sign that piece of paper I showed you, then we accept it. That would be the most probably easiest way to implement, but that relies on a centralized player. I would argue that decentralized approaches could be found, like you have to post a picture somewhere, put the hash value of the picture where you hold up today's newspaper and your passport in a transaction you sign, and then if 60 or 65% of the members of the Tontine agree that this is a valid proof of life, you're counted as alive. I'm just improvising that, but that would probably work as some kind of decentralized proof of life. But if you have a better concept, on the next slide there's my business card. Please do get in touch. Okay, yeah then, quickly, there's my business card. Get in touch if you want. Grab me later downstairs or something, or add me on LinkedIn or something like that. Thank you very much.
Next up is Hui Lin Chiew from Access to Insurance Initiative, who will talk about insurance regulations in a time of transformation. Just give us some time to set up a presentation. And after this session, we won't have questions and answers because we have the opportunity to dive a bit deeper into some of the regulatory issues together with Dr. Timo Bernau in a little fireside chat with Timo and Hui Lin. So, yeah, you ready?
Yes, but I believe... Yeah.
Oh, all right.
Sure, so maybe while we wait, I can just sort of introduce myself. So thanks very much, Jan. So my name's Hui Lin, and as Jan mentioned, I work at the Access to Insurance Initiative. And what we are is a kind of, we are a training and knowledge provider, a capacity building provider for insurance regulators, particularly in emerging markets. And our main mission is to help them increase access to insurance through regulations. And we have training, we have communities of practice, we have webinars and dialogues where we try and bring regulators together to discuss inclusion issues. I myself have been at A2I for about 4 years. My background before that was also very much regulatory. I was with the insurance regulator and the Central Bank of Malaysia, where I worked on inclusive insurance issues, financial sector development generally, sort of like liberalization, bank branching, always sort of from an access and inclusion perspective. So that's kind of where I suppose my roots are. And all that I've heard today is very new to me, but I guess in a sense that's good that we are trying to sort of bridge these perspectives together. And yeah, so today I'm here at some point to talk about insurance regulators, what insurance regulators do, and maybe sort of share some insights from my perspective on how regulators think. And maybe from there you can then also sort of, share your perspectives on how you feel decentralized insurance sort of fits into this sort of frame of thinking as well. So yes, that's me. I run out of things to say about myself. So maybe I'll just wait here awkwardly. Ah, okay.
It seems the laptop that had your presentation is out of battery.
Oh dear. Do they not have a charger?
I think it's about where the presentation can be shown from.
Can we use that one? I have the link. Can you use yours?
Yeah, I don't have Wi-Fi, but good.
Oh, you have no Wi-Fi.
Yeah, I think what about this one?
Something happened.
So it's just that we needed a password, but then... has questions. Okay. Yeah, it's the password.
We have it now.
Okay, we have it.
It's a Google Doc.
Yeah, it's just a...
Okay, then I probably need to go over there.
Oh, we have something. It's already...
All right, thank you everyone for your patience. Applause already. No problem. So let's just start by putting insurance regulations in very practical terms, right? So what do insurance regulators do? So firstly, they seek to prevent harm, right? They want to make sure that claims are paid when somebody puts their money down for insurance. Secondly, they want to make sure that anybody who gets into an insurance transaction is treated fairly. So from the point of product development and pricing, to the point of sales and educating the consumer, to the point of servicing when the customer is lost and needs a bit of help with what to do with his or her documents, and to the point of claims. So they want to make sure that people are treated fairly throughout the insurance process. And thirdly, they also want to make sure that policyholders and consumers generally are aware of their rights and they know what to do to act on them. So who to call when they want to make a complaint, for example. So that's the first part. And the second part is that regulators also proactively want to shape outcomes for the insurance sector. So a lot of them also have a vision for what they want to see, how they want to see the insurance industry, right? So they want to see better products and services that can service a wide range of people. They want to see more inclusive access. And maybe they also want to see modernization and digitalization and efficiency. So, you know, in essence, they are not opposed to things like blockchain, right? It's just maybe some other barriers that have to be overcome. So from a regulatory point of view, just to maybe share a little bit of how regulators see inclusive insurance. Maybe we talked a little bit early in the morning today about microinsurance, inclusive insurance, but basically from a regulatory point of view, it's about insurance that's accessed by people who are in the low-income population. But also in some other jurisdictions or some other countries, it's also about insurance products that are for people who don't have access to insurance for whatever reason. For example, cancer patients who can't get travel insurance. So it really depends on the country, but in any country, you will always find a group of people who can't access insurance because, as you know, insurance penetration rates are very low. And right, so in a lot of emerging markets especially, what do the excluded look like? We also heard a lot of very interesting stories this morning already. So, you know, it's really the 90% of people or employed people in Ghana who are informally employed. It's the 80% of Moroccans who are unemployed, who are youth or 65 and older, what they call housewives, low-income households, farmers, micro-enterprises. It's the 90% of the poorest rural and urban Indians, so it's not about just rural people, rural and urban Indians with no health insurance and who have to use up their savings, who have to borrow from people, or who have to delay healthcare in order to have a better quality of life, right? And these are all target groups that were articulated by their own governments themselves. So this is how they see inclusive insurance. But now back to the regulatory business. How do regulators operationalize regulations? So going from left to right, I'm sure this is a diagram that most of you understand better than me, but going from left to right, so if you fall within the definition of insurance legally and from regulatory terms, then you are likely subject to a whole bunch of regulations. And you can see it's structured in a very certain way from regulatory point of view. So regulators see that, okay, if you want to be an insurer, you probably have to be subject to gatekeeping requirements. So how much capital you have to hold in order to even start running in the first place. What does your board of management look like? Do you have good people leading the different departments? So that's just even to set up the business, right? And then to continue your business, you have to have things like risk management policies. How do you assess your own risk? Which is why the presentation we heard from Adi and Antonio today are really interesting, because this idea of own risk assessment is something that regulators care a lot about. Things like claims policies and processes. How do you approach that? Do you have the right people assessing claims? Are there conflicts of interest? Okay, and then if you are an intermediary, and regulators grew up with a very traditional idea of intermediary. In most regulations, you'll find that intermediaries are defined as the people who sell insurance, brokers, agents, and so on. And usually regulators will have requirements like disclosure, advice, how you explain a product to a consumer, what kind of commissions and fees and how much can you receive from the insurer as an agent, what kind of qualifications and training you have to have. And as a consumer, of course, regulators don't technically regulate you, but there are requirements we heard about today, like KYC and AML. But as a consumer, regulators generally try to set up an ecosystem for you so you know where and how to act on your rights. So things like complaints hotlines, dispute resolution bodies, and information and education. So that's if you're an insurer, and that's a whole lot of things. I spent 1 minute talking about what kind of regulations an insurer would have to be subject to, right? So that's a lot. But if you're not an insurer, usually what regulators do is to assess whether you pose significant risk, and that means, whether you are likely to compromise some of these outcomes that I talked about, whether you are likely to be a scammer, or whether consumers are likely to think you're a scammer, and then, so if you're not an insurance company, regulators will consider these factors, assess if you pose significant risk, and then they might decide, okay, if you pose a lot of risk, they might subject you to intense monitoring. So asking you to report certain data every month or something like that, which is, of course, a huge compliance burden. They might, one quite popular thing that happens in the inclusive insurance market is this idea of formalization, where, for example, if you are cooperative, offerings of peer-to-peer risk protection, if regulators feel that maybe you're growing a bit too much, too fast, they might ask you to then apply for a license, and they might create a new licensing framework for you. So in that sense, there is some risk or considerations in growing big as well, right? And of course, if you are not an insurance company or you don't fall within the definition of insurance, so the last sort of branch of that diagram, regulators might subject you to some light monitoring. They might just say that, okay, as long as you don't call yourself insurance, I don't care what you do, just use some common sense, right? So this is kind of the frame of thinking of insurance regulators. Now, the difficulty is, of course, when there are gray areas. For example, people like Acre Africa and Pula, who bring so much value to the insurance market, but they don't fall neatly into these buckets, right? Insurer or intermediary. So how does the regulator deal with these things? So, I mean, different regulators have found different ways of trying to sort of retrofit new innovations into this structure. But generally, it's kind of these three approaches. So firstly, what they might do, as I mentioned earlier, they might come up with like a dedicated licensing framework for you. They might come up with a new product category for you, like microinsurance, or in Ghana recently, there was this new innovative insurance license that they created under the new insurance law. What that means in detail, nobody really knows yet. There's also regulatory sandboxes and piloting, so carving out sort of a safe space for new innovations before you transition into more formal licensing arrangements. And then there's just generally updating of regulations, so allowing new digital processes, allowing e-signatures. So the nice thing is that regulators are nowadays, they really recognize the value of being technology neutral, right? So they really understand that, okay, it's not really about the kind of technology you use, but to what outcomes and what activity you're doing. So that, to me, is at least a more sort of future-aligned way of thinking. So one interesting kind of topic in this area is the idea of index insurance as well. There was a whole lot of debates around whether parametric insurance is even insurance. And some regulators have actually just decided they're not insurance, they are derivative. And as far as they're concerned, they're not going to regulate it. So there are these sort of different nuances as well. But what then makes insurance insurance in the first place? Right, there are a few things that are sort of common characteristics. So usually there is sort of a description that says that there must be a sort of legal contract where one party is often obliged to confer benefit from one person to another when you have a fortuitous event. So an event beyond anyone's control, so there's no moral hazard. And usually it must involve some kind of payment of premiums or some kind of consideration from the policyholder. And finally, there should be some kind of insurable interest, which is why with parametric insurance, it was a little bit complicated. But of course, like the explicitness of these requirements and how it's worded in every country, sometimes if we are in the US, every state can be quite different, and that's often the challenge. So I guess the question is also then, how does decentralized insurance fit into this framework? So the other interesting thing about regulators is that, especially when you're dealing with emerging market regulators and low-income segments, even when it's not officially insurance, they tend to be extra careful. So this is a quote from a paper by the International Association of Insurance Supervisors, and this was specifically about index and parametric insurance. So the idea that there's still a need to ensure that the insurance market is not undermined for any reason by a product that consumers perceive as insurance, but is not legally insurance. What this means is, as far as some regulators are concerned, if there are farmers being approached by anyone who says that, oh, you know, if you pay me something for this, when this happens, we'll give this to you. If anything that could be insurance-like, it might be sensitive for regulators, and this is what they mean by this statement. So the problem with gray areas, and I guess it's probably something that's a struggle that most of you really appreciate, is that it takes regulators time to respond, right? Because they have to do all this extra research, and honestly, a regulator is like any other organization. They don't have resources, they don't have people looking into new topics, and when a query comes into their email, they're like, oh no, what do we do with this? Let's check with our boss, let's check with our boss's boss, let's arrange a management meeting. And in a regulatory world, that really takes forever because they have a whole queue of things for management committee to discuss already, right? So it's a lot of research that needs to be done, a lot of indecision, internal or legislative processes. And also the issue is that regulators are conservative animals, right? So whenever there's something new, there's a risk that you will end up with extra cautious requirements. So I know one regulator where when they saw sort of a P2P insurer operating in the market, they immediately sent out an announcement to the public saying, this is not insurance. And it actually caused the company to lose some members because they thought that they perceived it as some kind of, fraud warning. So these things happen, and it's quite amusing. So, yeah, so I guess this is where I will leave you, and my question to you and to Jan is really, where does decentralized insurance fit in?
Exactly. Let's thank you very much for this very as promised, we have now the opportunity to dive a little bit deeper into how regulation affects massive adoption and a few interesting regulatory questions in our fireside chat with Dr. Timo Bernau, who is the leading fintech partner at the Munich-based law firm GSK Stockman, where he has been a partner for, I think, over 12 years now. Huh?
Long time.
Long time. So, oh yes, thank you. So, let's dive. I've prepared a few questions that I'm particularly curious about, and of course, I can't wait to ask you guys about. Can you hear me well? Yes. Huh? Ask you guys about a few points. So, one thing I always think about when it's one of the most important features of blockchain technology is that all transactions are recorded on a immutable ledger. Most status changes and everything can be recorded there. So that provides an insurance product that is based on the blockchain with essentially a perfect
audit trail, if you want. And my thinking is always that I feel this would be extremely valuable and useful for regulators as an audit trail that they can also use. And in principle, the fact that this technology is used should be making the supervisory processes for regulators much more efficient and much more effective. But it seems they are not really using this, and I always wonder why are they not jumping on this possibility or on the technical possibilities? Do you have any thoughts on this, Timo?
Well, actually, first of all, I would say I agree. Yeah, in the perfect world, the DLT solutions is actually the perfect world for regulators because it's traceable. You can verify it, and it's immutable, etc., etc. And I think we will get there, but it will take some time because, as Yulu said, the first thing the regulator sees is a risk, yeah. And also a couple of speeches earlier today, we have learned that the entire crypto space needs to get a little bit more bored, yeah. And as long as we have these hiccups like scams and these are quite prominent in the media, I think the regulator, who is not really in all the details, yeah, all these people here, they know what we are talking about. However, the regulators, they are many old people, many people who have a lot to do besides of taking care of innovative business, and they're not getting paid for doing extra work, yeah? So it takes just a long time to get familiar with innovative systems. So I think that's the main issue. It will take more time for them to understand the benefits of the system.
What do you think, Hui Lin?
Yeah, I mean, firstly, I can only support what you say about how it will take regulators time. But I would say that maybe there is a little bit of silver lining in the sense that regulators are, at a global level, starting to discuss this idea of a supervisory node. So the idea that, you can plug something into the blockchain and, do a little bit of like real-time supervision. So I think on a very broad level, regulators are sort of excited by this idea. But as you say, I mean, the first thing they think about is, oh, what are the risks of this? What are the legal risks, any data risks? How do we plug in the system in a way that preserves the confidentiality of so-and-so? And, how will it affect market dynamics? So, these are the kinds of things that come immediately to a regulator's head. And I feel that maybe the best way forward is, I feel like, there are some days where I wish, putting myself on the other side's shoes, we could just sort of walk up the regulator's door and just knock on it and say, look, this is how it works. We've done it all already. Click on this, click on that, click on this. Look, this is all you need to do. It's fine. So, maybe something as concrete as that, I feel, is the ideal way to convince a regulator who is risk-averse.
Probably just one thing to add. Why is this so ideal, especially for the insurance sector? If you talk to the regulator and see all these reporting requirements, which are massive, especially in the insurance sector, most of the reportings the insurance companies have to do every day or on a periodic basis, the insurance regulators cannot even cope controlling all these data. So most of the data are somewhere, but no one is really controlling it, yeah? Just when something happens or they have a certain interest in doing an analysis, they actually look in all the files. So it is a massive really benefit for all these, let's say, reporting requirements and the monitoring and compliance about it to have, let's say, a self-fulfilling system here.
Yeah. Can I just maybe add one last thing to that? So I think a lot of regulators are trying to invest more and more in regulatory and supervisory technology. But I think maybe the issue there is that you really only have one or two companies who are dominating the market, providing the sort of data reporting technology. And in that sense, maybe they haven't seen the benefits of blockchain yet because there is another technology there that is already available, and they're really, really selling this to regulators as well.
Oh.
Yeah.
Hui Lin, you were speaking a little bit about sort of the reasons why regulation exists and what they're trying to protect, which is, of course, the consumer's interest and the insurance market in general. And I'm going to get to that point of if whether or not insurance or someone who offers something similar to insurance is posing a significant risk. So if you look at, let's say, digital insurance policies that run as insurance smart contracts on the blockchain, in principle, they're self-executing code, and they're equipped with a sort of technical certainty where it's essentially impossible that if an insurance payment is due, according to the terms of the insurance smart contract, it will be paid. It's technically impossible. So they might not be backed by an insurance company which complies with all the legal requirements of the regulation, but the technical certainty makes it essentially, or provides a similar protection to the consumer and the insurance market as a whole. So that's another time the question where I don't understand why insurance regulators don't seem to recognize the power of this element, and do you maybe think that at some point they'll come around to think actually blockchain-based insurance product offerings of sorts are not posing a significant risk because of this technical certainty? Do you think this is going to happen at some point, or?
I mean, I think that's a really interesting question, because is it really the certainty of the money being paid out, like, or the will or intention for the money to be paid out, that is the concern of the regulator? I mean, of course, some regulators worry about insurance companies who have bad governance and who might not pay out even when they're promised to the consumer. But a large part of the regulator's concern is also sort of the financials behind it, you know, how it's structured, how many layers of capital, and how secure they are. So to me, that's maybe the part that worries regulators a bit more. And if there's a way we can, you know, decode some of the terminology that we've seen in the conference today and try to explain the financials to regulators a bit more clearly, I feel that that's a step towards that. I mean, of course, the other side is that then regulators also need to understand quite concretely what does, you know, immutable and these concepts mean. I think I like some of the discussions today where you talked about, you know, the probabilities of something being hacked and things like that. I think these are the kinds of details that are probably important to be illustrated to the regulator. I mean, it is probably going to be a slow journey. I'm not going to lie. I mean, even with mobile insurance, it took years for it to grow. But I think the best place to start is by providing sort of more relatable information.
Yeah, I mean, especially, sorry, just we talked about risk pools today quite often, and I mean, in principle, you could program a risk pool in such a way, or the smart contracts maintaining the risk pool, you could program it in such a way that they simply no more policies get issued if there's no capital to cover it anymore, which I guess would solve a lot of the solvency requirements that that the regulator normally has to check.
Yeah, I was just going to jump on this point. I think that's the main problem insurers have today. So if we can solve this, like with the smart contract protocol, it would be a major step forward. Yeah, and it is also not about just the existence of a sufficient risk pool, but also about adjusting the existing contracts. Yeah? If you have, let's say, 20 years ago, 30 years ago, you've made a capital life insurance contract, yeah, you may be fine off, but if you do it today, you don't get any good contracts anymore. Yeah? So there's no real adjustment policy in it, and as the solutions we've seen today, they totally work differently. Yeah? It's more, let's say, a community approach, and that would be actually helpful for everybody.
All right. So I guess until regulators start sort of understanding the potential that new technologies, especially blockchain technology, delivers, all the sort of companies and projects operating in the decentralized insurance space are forced to make a fairly difficult choice. It's either in or out, meaning either you do work in the regulated framework, which means you need to get regulated yourself, or you need to find a partner with someone who has a regulatory license, or you need to decide you're going to be out of regulation, which means you're going to find some legal model where what you're offering is just short of insurance. And I'm sure some projects have an even bolder approach, and they just say, well, we're going to operate outside of the regulation and hope for the best. But how do you see that? Where's the trend going, and have you seen any interesting legal models and developments that make the choice a little bit easier for the companies operating in the space?
I think it's really depending on in which gray area you are, how black or white you are. So if you want to address the European or German market directly, most companies we see, they mingle or work together with some kind of insurer. However, if you've got a product where you are to a certain extent confident that you are fine working without an insurance company, you can do it, and people do it, also with the hub in Europe. Everything which is in between, especially in the DeFi sector, we see a lot of companies trying to avoid being domiciled in the heavy regulated markets like Germany, for example. And this perfectly works out, at least for the moment, if you do not address residents in the European market. Yeah, we've seen, for example, it's not an example of insurance business, but of DeFi in general, like Cake DeFi. They had a German website and German contacts, so they get a notice by BaFin, a public notice, and they just extinguished everything which is German on their website, and they continue what they did before. They now still decide to apply for a license, and that is what we have seen for many market participants. They start actually without a license, maybe offshore, and the deeper they get into the European market, the more consumers are onboarded on their systems. They think about, okay, probably we need some local support, we need marketing, and then they start to work together with the regulated player. So it's an evolution, I would say, yeah? If you are a startup, if you are young, you may have the choice to start outside the European market or German market. The more successful you get, you think probably about working with a regulated player, if needed, of course.
Yeah, I think we spoke about something which I'm almost sure you're going to mention now before the conference. There is I think what Timo is describing is a little bit similar to what you described as a concept too good to fail.
Yeah.
Do you think that this is a model that some projects will be adopting, and will they get away with it?
Yeah, so firstly, to add on to your points, I think a lot of companies, I agree, try to do that also in the inclusive insurance world, like to try and start something small and then sort of try to avoid regulations if possible. But I mean, what you're saying now, like choosing domicile wisely, I think with inclusive insurance, that's maybe a little bit more difficult, right? Because you're really dealing with local stakeholders. You're dealing with people who expect to buy from companies that are local, and they're not really going to buy into the idea of, buying online from a global player that's not necessarily, licensed in their country. So I think that's the part that's difficult. And so I guess then the question is, is there a way that you can have as light touch regulation as possible while you're trying to achieve proof of concept and rollout, but at the same time, not basically get in trouble with the regulator later on when you've grown? Because, I mean, with low-income markets, especially emerging markets, regulators are very sensitive to the needs of these segments, right? And they are not going to be very happy if for any reason they think that there's been a company that's, sort of interacting with around insurance with low-income segments and something went wrong. They're not going to be very happy about that. So ideally, there's a way that, if there's a way you could become too good to fail, like through your proof of concept, you show that you are able to grow responsibly, you are able to anticipate the technical risks that come with a blockchain platform, and you have experience in fixing them, and, basically regulators think that way. What are the risks, and how would you address those risks? So if you can sort of show, firstly, okay, look, clearly we are benefiting farmers through our program. This is the claims that we paid out. These were the losses we made. We paid out at this point in the season when they needed it most. And this is how we've been dealing with bugs. This is what happened. Something went wrong. We fixed it. maybe there's a chance, in that sense, that regulators will see that, okay, this is not something that this is something that I can't help but want to support. That's what I meant by too good to fail. And I don't know whether it's possible to achieve something like that.
Timo, you mentioned a little bit the European market and the German market, but how do you think the EU's MiCA regulation is going to affect decentralized insurance, if at all?
Yeah, I think there's an effect. I mean, we see two very interesting developments in the MiCA. For everybody who's not aware of it, the MiCA regulation is the European regulation. It's not finalized yet, but we have the latest draft for March for any crypto assets, issuance or trading or whatsoever in Europe. And there's just in the latest draft, two very interesting things came up, which may be also a blueprint for the insurance market. One is quite negative if you are outside of the European Union. As I just said, and that is the concept in all the banking or financial insurance laws so far, if you are outside the Europe and you do not address European residents, you can do what you want, to a certain extent. So it's the so-called passive freedom to provide services, It's actually in the OECD code for the correspondence insurance. If the residents on their own initiative choose to have insurance in the US or somewhere else, it's okay. You do not need to be regulated within the European Union. However, now in the MiCA, there's a new concept. I'm not sure if it's really going through, but it has just been put in, that if you have within your client base European residents, you need to have a company within the European Union and being regulated. So irrespective of addressing Europeans, that's a total change of regulation. So why is this? Because in the past, many regulators say, okay, if you do not address the German market, we don't care, because the people here, they cannot, let's say, trust in engaging with a regulated entity if they, let's say, look on their own. However, the times have totally changed. There are people look on Twitter, Discord, or whatever, what's the best solution for their problem. So this doesn't really work anymore. So maybe we see the same thing in the insurance market, but I would expect it to come a little bit later. The other, let's say, more positive thing is we see in the MiCA also the approach that if you are a DAO or a decentralized system, you may not need to be regulated. If you're not controlled by anybody else and your systems run automatically, so you really have no a controlling body, you do not need a regulation. And that's also totally new in the regulatory space. So that might be, especially for peer-to-peer insurance, a very good approach if this will develop also in the insurance sector.
Yeah, that is very interesting. I'm mindful of the time, and I think people also have been promised a little networking drink session. So this is my last question now. Mainly for Hui Lin, I think, but of course you're welcome to answer too. According to Article 8 of the Paris Climate Accord, it says that the subscribing parties should enhance understanding, action and support with respect to loss and damage associated with the adverse effects of climate change. According to Section 4, letter F, areas of cooperation may include risk insurance facilities, climate risk pooling, and other insurance solutions. Do you think that this will, or that this clause can be used to open the door to lighter touch regulation or to accelerate regulatory processes and programs like sandboxes, which are making it possible for technology providers or for people in the decentralized insurance space to deliver solutions? Because I always think, okay, well, the people in the decentralized insurance space, in theory, like we and the Lemonade Climate Coalition, very soon we will be able to deliver solutions to farmers who desperately need them. a lot of people are looking for those markets as an area where they can scale. Well, what do we tell these farmers that why the solutions that are theoretically there and that could be delivered to them, they're not getting to them because of regulation, which is ironically supposed to protect the farmers. So I was looking at this Article 8 of the Paris Climate Accord, and I thought maybe this is something that can open the door to lighter touch, or to incentivize regulators for lighter touch regulation, or develop programs at least. What do you think?
Yeah, so I think the interesting question that this brings up is, who really is the regulator stakeholder, right? I mean, of course, you have the consumers, but a lot of time, regulators also really respond to what sort of the government strategy is. So if the question is, okay, will these generally international agreements, let's say, right, international covenants agreements as a concept, will that give sort of enough push at the government level to then incentivize regulators to, accelerate certain things like decentralized insurance, as if they know there is a POTS climate goals? I would say there is definitely hope there, because a lot of times where we see regulators take a very active role in climate, it's really been pushed by these sort of international conversations coming to the governments, coming to regulators, and it's really accelerated a lot of work in the climate space. So I would say yes, there is hope, I think, and I think it will be really nice if when we approach countries, we can sort of like pull the ministry into the room and pull the regulator in the room and go, okay guys, look at this, we have a common mission here, can we try and achieve this together, right? That would be great. I wish we could all do that. Yeah.
Yeah, just one small point to add. I think also yes. Why? If you see the entire ESG space, when this regulation came up, most of the people who are working in the field of financial or insurance sector thought, okay, most of it's optional. You just have to explain what you do. Yeah. So we said, okay, some company may do it, some don't, but the total difference came actually. Everybody is so keen on being super obligatory on this. So everybody wants to have a good stamp on the ESG. They all want ESG compliant products, and it's really a change of mind in the industry. That's what we notice, and we got a lot of questions by the regulator, by product initiators, by investors. So I think there's a really good chance this time that we also get a better regulation to enhance these fields.
Yeah, hopefully we'll see some more interesting news in that space. Then let's close with this hopeful message. We've come to the end of the conference. Like I said, we have now some desperately needed networking drinks. I'm sure you're all thirsty, so please make your way downstairs. I don't know if you want to say a few more last words, Christoph? Or shall we close the conference here and let people have a wonderful little drink?
Yeah, let me just say thank you to all of our speakers, attendees, and also, of course, to the huge team which made all this possible technically, and also to Miet van Berlage, who provided this tremendous location here. So it's a great thank you to all of you who have made this event possible. And I think we have a lot of stuff to discuss now in the after party, and I hope you enjoy it. It's just, I think, in the ground floor, in the cafe. And yeah. So yeah, that's important. It's sponsored by M-Stable, but here I need to hand over to Jan to explain who is M-Stable.
Really? So, I'm not the most technical person, but I can tell you that M-Stable is working very closely with Nexus Mutual, and well, I cannot say about them, to be honest.
Okay, so is someone here from M-Stable? So it would be great if you could introduce yourself here. So it's great that you sponsor this event, and so you should also have the opportunity to present yourself. So
think they're already drinking.
Okay, so great, thank you to and shout out to Stable, and have fun and enjoy the evening. And I hope we see all of you in Bogota, where we at least currently, and it's tentative, so I cannot guarantee, but I hope that we can organize a second D1Conf this year in Bogota together with DEFCON. We are in contact with the DEFCON team already, and of course you will be able to ensure your flight to Bogota. And yeah, let's see. I hope I see all of you in October in Bogota, and have fun until then. See you and bye-bye.